There we go. Yo, what is up for everyone watching this on the YouTube replay? I hope you're having a great Sunday. So, I want to go over some undervalued stocks I think are pretty attractive to buy this week. Last week, the market was a little red at the end of the week because Jerome Powell officially stepped down as chair of the Federal Reserve, and now we have Kevin Warsh, and he's really changed how rates are looking. So if we look at bonds right now, a lot of the interest rate sensitive sectors are really slugging right now because actual bonds are. Yeah, look at TLT right here. It's not done too well. So anyway, let's go over some cool stocks I think we should buy this week that are undervalued. So one of the first stocks I've actually recently bought in my portfolio right here is actually FUTU. And I'm now total return negative on my position. I'm down 0.03% on my FUTU position. Here's why I just love this company. I'm not just recommending them because they're on a dip. I'm recommending them because they're in a sector I love, the brokerage sector, and they have phenomenal growth. I mean, I'll just show you the numbers for yourself and you can draw your own conclusion. Hey, what's up, Nick and Monkey D, Luffy and Looney? Good to see you all. So check out the revenue growth year over year. The revenue grew 45% all organic, and the revenue was 827 million. On this 827 mil of revenue, they kept an after-tax net income 433 million. And that's really after they paid exactly 100 million of taxes, which means their net margin is a freaking 52%. This is like a margin expansion play, the highest net margin ever, basically collecting royalties. That's why I love the brokerage industry, because literally for every dollar that comes in, they keep over $52 after tax. So yeah, they make a lot of money from interest income. They basically just collect a little fee every time you park cash. So look at this. So they give you a 3.35% APY on your idle cash. They keep a 4% APY on it, and they just pocket the difference. And that's very high margin for them in the long run. So yeah, that's why I like FUTU. I did just buy them, or well, I just bought more of them, but I am now total return negative on my position. Another cool thing is they sometimes pay special dividends, which are pretty cool. They actually just announced one a couple weeks ago, $2.60 special dividends. So whenever the stock's undervalued, sometimes they'll do a surprise dividend for you. And that dividend actually paid me here. I'll show you this. I'll log being fully transparent. I'll actually show you my dividend income. Yeah, here's my account over the past year. We're only up 21%, and the S&P 500 is up 28%. So we've definitely underperformed. But check this out right here. We got a $55 special dividend from Progressive, but then a $36 special dividend from FUTU. So pretty cool. That's one of the top stocks I think are really undervalued right now. And what's up, Monkey D. Luffy? This is funny enough you said that stock, because this is the next stock I think is a great buy the dip opportunity. And I did just buy another share of this company. So I'm not just saying this. I'm actually put my money where my mouth is. I'm buying more shares. Look at this. This is where I've been, all these little B's, those are my buy orders. Like I was buying a share here at 128, 129, up here even at 135, and it's at 125 today. So this is Amphenol. What does this company do? Well, they do the copper cables and fiber optics, and some of their big customers are NVIDIA. NVIDIA uses their copper cables. Google's TPUs do as well. And this company's a growth one. So you really value them off next year's net income. And this company only trades at 23 times next year's net income. Here's why that is super justified, and actually I think it's undervalued for the growth that they have. Their main business, communication solutions, look at this growth rate year over year. It's up 87, after grew 90, after grew 12. So they're on a streak of growth. Their aerospace and defense business is up 33, after grew 39. So when we combine all the businesses together, the revenue on average or total grew 58% year over year. For a growth stock, that's what you want to see, for the revenue just to hit a new record every quarter. And it's not just the revenue that's up 58, but it's the profits that are up 83. It's their most profitable quarter they've ever had in terms of profits. They had a slight one-time adjustment to their net income, so don't worry about that. They actually made a record 1.3 billion net income, but they had a one-time acquisition charge from this CommScope acquisition. Anyway, you really value them off a forward PE to see how cheap they really are, and they're literally only trading at 24 times next year's net income. I think it's very fair. Plus, you get a nice dividend, a 0.67% dividend yield that they raise faster every year. So this is an AI beneficiary, kind of AI infrastructure play. So instead of just buying NVIDIA, I'm a fan of the whole ecosystem. Buy the companies that are doing the HVAC work, buy the companies doing the complex electrical infrastructure work, buy the companies that are cooling down or powering the data centers with nuclear energy. I actually own them as well. I own Constellation Energy. They own 33% of all the U.S.'s active nuclear reactors. So they're pretty cool. Yeah, here's our Robinhood portfolio. Yeah, I haven't even done a portfolio update yet. Here, I'll do a quick portfolio update. I usually do those at the beginning of the streams, but I forgot. So yeah, here's us the past year. We're only up 13.3%, and year to date, we're actually negative. So yeah, full transparency. Oh yeah, here's our Roth IRA as well. Down over the past year. We started this pretty much exactly a year ago. We're down 3%. We're trying to bring the growth back. And here, we just got 5 holdings in here. We have 5 holdings in here. We have 6 holdings in here. And then 6 holdings in here as well. So yeah, kind of, I like to keep simple portfolios, concentrated in just a few different holdings. 13% is great. That's a blessing. That is true. That is great. But if that has underperformed, so yeah, over from exactly 1 year ago, we're up 13.3. If we go to the S&P 500, here's why, I would have probably been better off just buying the S&P, but I like individually picking stocks. The S&P 500 is up 25% the past year. This is why I always recommend the S&P 500. The average retail investor and hedge fund literally cannot beat the tech-heavy S&P 500's 8 to 10% CAGR. So if you can't beat it, you at least got to own some of it. At least own a little bit of your portfolio, or at least own some of its top holdings. Hey, what's up, Pierre and ZXC and Kivo? What's up, y'all? What are your thoughts on treasury yields? Yeah, dude, bonds are so cheap right now, but it's also because we are not expecting any rate cuts basically for a year. So you guys know where interest rates are right now. It's basically going to be where they are for another year. And that's why bonds are getting, the yields are going up. But as you know, when yields go up, as the stock price goes down. So literally, here's a cool play. If you believe interest rates are going to go to 0% again, because right now rates are like 3.3 or no, it's like, I don't know, 3.8. But if you believe rates are going to 0, this stock, TLT, the US 20-year Treasury, will appreciate in stock price back to $150. So if rates are ever $0%, this will be $150 a share. But markets just don't believe it. There's inflation issues, with all the oil and gas problems. Like, there's no way we're going to get rate cuts because of all this inflation. So anyway. Hey, what's up, Matt? Good to see you. Don't use Robinhood to trade stocks. Why not? I actually do use Robinhood, the FDIC insured. Like, here's the crazy thing. Like, people are like, Robinhood's risky. Even if they go bankrupt, you're still FDIC insured for $250K. So, same with all these brokerages. But it's good to know. Actually, I'm a shareholder of Robinhood. There's no way they're going bankrupt. They're actually a money printer. Believe it or not, here's their net income right here, making like a couple $100 million of after-tax net income a quarter. So I'm not worried about Robinhood. But yeah, let me know why you think that's why I love it. There's SIPC, FDIC insurance. So Looney, the member, good to see you, man. Shout out the member. He says Brookfield Renewable. Let's check it out right here. So unfortunately, this stock has been flat since 2020. Maybe it's an oil and gas company. So they've been flat since 2020, but let's go figure out what it is they actually do. So hydroelectric. So maybe they own some dams. That's actually pretty cool. I'm a fan of that. Powered by water. Attributable. So they own stake in something. And then they're also in solar and wind. So, they're a utility company. Let's see what they own. I mean, I kind of like to see what, reject cookies. Y'all ain't getting my cookies. So they have is this actual Brookfield or Brookfield Renewables? So I guess 700 or 47 gigawatts. All right, cool. Hydro. Okay, can we see what actually properties you own? I guess there is no. Anyway, what we know is they own some hydroelectric, solar, and wind. Unfortunately, if we go to net income right here, that's the one scary part. This is maybe why the stock isn't doing so hot. They've just lost money. Yeah, check that out. The profits are really inconsistent. And over this past 4 quarters specifically, all they've done is lost a couple $100 million the past couple quarters. So it's tough. How's the revenue growing? Let's see and look at this. So here's a start to make sense as well. The revenue, the lifeblood of the company, the sales declined 3% after it fell 20%. So I think we're now starting to understand why this utility has underperformed a lot of the good utilities. Someone said, isn't utility sector like recession proof? I like to think so, but it's definitely not recession proof. It's recession resilient. People still pay their electricity prices. But my favorite, I have 2 different utility stocks. I have Southern Company. This one I really like. Like, look, on average, this stock right here just does like 8% of your money back. There was the COVID crash, but it recovered quite quickly. So if you buy the stock right now, what's cool about utilities is you usually get a good yield. So this SO stock right here, you get a 3.3% dividend yield, and they only trade at 20 times next year's net income, which is pretty fair for a utility. They're one of the cheapest yet highest yielding utilities, and I love all their subsidiaries. They own like Alabama Power and Gas, Atlanta Power and Gas, and specifically like Atlanta is booming right now for data centers. And they're kind of actually being boycotted right now because they're putting like transmission lines like 12 feet away from residential houses to maximize profits. And I don't even know. So let's keep going here. So I'm so behind. I do apologize if I'm missing some of y'all stocks here, but I appreciate everyone that's here. I stream every Sunday this exact same time. If you'd like to hit the follow button, I sell absolutely nothing. Just on here giving my opinion. So next up, what's some of your favorite financials to look at on growth stocks? Yeah, revenue growth, net income growth, figure free cash flow. So someone said Solar Edge. This is a solar stock. Wow, they actually went up 22%. But I can understand why this stock, had such a massive decline from its peak up here. You know, this stock used to be, $300 and now it's $60. Here's why they fell before today, but I also want to see what caused this rally. So they beat on revenue. They've narrowed net income losses. So that's the one bad thing about SolarEdge, why they've always been unbuyable in my book. They just lose and like it used to be a decent company. They used to make net income every quarter, 20, 30 million, but ever since, 2024, all they've done is just lose like a couple hundred mil a quarter, sometimes like a billion. And when you lose like 400 million a year and your whole company's worth under 4 billion, you lose 10% of your entire market cap a year. But I just noticed something from the analysts that does make me happy if they're right. Notice they're only going to lose 6 million in 2 quarters. So we just really want to see them narrow losses like this. Solar panels, they're kind of a low margin commodity. China has really just started printing out solar panels at such a low cost. My favorite solar play, if I was going to buy a solar stock, I also love First Solar. So as we saw, that other company lost a bunch of net income every quarter, or the net income was kind of choppy. Well, here's an alternative that I just like. It's also kind of on a dip, that prints money. Check this out. This is every quarter. They're making 3 to 5. Look, we can zoom out for all the time. Like they just print a couple hundred million of net income a quarter, and they have a fortress balance sheet. So First Solar would be my solar pick, and they only trade at 12 times next year's net income. Seems pretty fair to me. Happy Sunday, Carlos. He said Celsius. Yeah, does anyone like energy drinks? Is Interactive Brokerage better than Robinhood? I don't know. Are you talking about the stock or as a brokerage? Because I've not used Interactive Brokerage, but we can analyze IBKR. That's a good stock. And Berkshire Hathaway. Yeah, Berkshire Hathaway just did some questionable moves that I'll mention in a little. What happens is, FA, this apper, it's linked in bio if you'd like this brokerage I'm on. So here's Celsius. This is your energy drink company, kind of like a Monster. And they own Celsius, they own Alani, and they own Rockstar Beverage. So here's Morningstar's research. They say they're undervalued. So their strategic acquisition of Alani and Rockstar combined with the PepsiCo distribution partnership will drive long-term value growth in the fast-growing, ready-to-drink energy category. So the cool part is the valuation is really fair. So if you look on the right, the forward PE is only an 18. So they only trade at 18 times next year's net income. And why are we valuing them off next year's net income? Because they had a one-time adjustment 2 quarters ago. It says in Q3 they lost 61 million. They actually made 166 million, but they had a one-time distribution termination fee gap adjustment. So one-time off fee that made their net income go negative. So that's why you value them off a forward PE. But I suspect I think I know why Celsius is on this downtrend, and it's not a Celsius problem. It's actually a whole entire industry problem. Like look at General Mills. It's kind of just like the whole food category. General Mills is at this new multi-year low, and it's not even just the food package, it's like the restaurants as well. Like look at Wendy's stock. Here is COVID. Wendy's is lower than it was in COVID. Actually, Wendy's stock is lower than they were when they IPO'd in 1997. So if you bought the 1997 Wendy's IPO, you were down over 50% on your money, which is unfortunate. Jack in the Box as well. It's another one. Jack in the Box, Cracker Barrel, Red Robin, Krispy Kreme. They're all at like their 1999 stock price level. It's kind of sad. So maybe it's all the Ozempic or something. Hey, Larry, dude, thanks for that gift there. And Melissa, thanks for those gifts. I appreciate that. So next up, can we do Elf Beauty? Yeah, Gabriel, remind me to get to Viva Systems too. So this is like a beauty stock right here. So yeah, usually these have pretty high margins right here. So anyway, yeah, Elf Beauty, the stock has been flat for a while. Elf is technically the same price that it was in 2022. So it's been flat for 4 years. But the valuation is starting to get cheap. If you look on the right, they only trade at 19 times next year's net income. So, and here's their net income. Yeah, it's kind of been flat from what it was in 2024. So that's probably why the stock price is the same price that it was in 2024, because the net income level is the same. And so they can't escape this market cap. So, but they did just do an acquisition, it looks like last quarter for $600 million. I wonder who they bought. Maybe that's why that's probably why the balance sheet changed out of nowhere. Changed the assets went up and the revenue started growing really fast again. So anyway, yeah, they're supposed to stay net income positive, 6 mil next quarter, 55 mil the quarter after. So 19 forward PE, not too shabby. Actually, Morningstar says they're undervalued, highly profitable operations and robust revenue growth, presenting an attractive opportunity despite a lack of an economic moat. So yeah, kind of some other players in this industry are Ulta. Ulta is a money printer. Ulta Beauty. Actually, I'll pull up this one real quick. Uh, which app website is this? Yeah, hey Nolan, I'm on a brokerage actually. It's linked in my bio there. It's called Moomoo. But yeah, look at Ulta Beauty. This is another one that trades at a slightly cheaper valuation. They trade at 17 times next year's net income. And check out Ulta Beauty's profits or net income down here. They're making like a couple hundred million a quarter. It's kind of always been that way. So this one might be a little bit of a safer buy, but they're both probably going to trend together because look, this one's also at like a kind of multi-month low right now, same as Elf Beauty. A lot of the discretionary names are. All right, next up. All right, I'm so behind. I apologize. Oh man. I made a medium-sized position in the DRAM ETF 2 weeks ago. Yeah, check this out. If you're wanting exposure to the memory shortage, you're like, I don't know whether to buy Micron or SanDisk or what, you could, or Samsung, you could just buy this ETF that breaks your money up for you into all of the RAM stocks. So it's kind of like the SMH ETF. If you don't know which semiconductor play to buy, you're like NVIDIA, AMD, Taiwan, Intel. Well, you could buy ticker symbol SMH. It just diversifies by market cap all of the top semiconductor names. All right. Oh, hey, watch out for that person in chat there. Yo, I don't sell nothing. I have no course book. What's up? I never follow you, dim you, and I definitely don't have a Telegram. So yeah, I sell nothing. I'm just on here giving my opinion. Hey, and Holy Sheet, dude, thanks for that gift there. I appreciate you. Yeah, if you got a stock you been looking at, let me know. And I do, again, apologize if I'm missing some stocks or I see a lot that I miss in here, but I appreciate everyone that's here. Carlos says Affirm. This is a buy now, pay later company. They have some partnerships with eBay and Amazon. So you can actually on Amazon, I never recommend doing this. It's like pay in four, buy now, pay later. You can do that on Amazon through Affirm. So they actually just got net income positive, which is the good part. Because if we zoom out, this used to be a hard company to buy. Here's their net income. They're losing 200 mil a quarter. It's a tough buy. But now they're making over 100 mil of net income a quarter. And it's supposed to it's supposed to be 115, 120 next quarter. And notice they beat on net income by a good margin every quarter. So I'm actually I'm liking what I'm seeing at Affirm. What's the valuation though? So they are expensive, probably because they're just now getting net income positive, but they traded a 40 forward PE or 40 times next year's net income. So they say Affirm is just slightly overvalued. While the company benefits from strong volume growth and expanding operating margins, its high exposure to economic cycles and reliance on external funding for its buy now pay later loans will warrant investor caution. So that's the one thing they're suspecting these buy now pay later loans in a recession, they just won't get paid back. These buy now pay later stocks will get smoked in a real recession. So it's the one thing to be aware of. So I saw Google. Yeah, I love Google. Hold up. Let's go to Google. I do own them actually in my Robinhood portfolio. They're my largest holding in here. One of my best performing stocks. Check out Google. Just since exactly 1 year ago, Google's up 132 and I'm up 141. So it's not like I bought the dip on them. I just bought them pretty much a year ago exactly. And the stock has just done so well. I'm surprised. And this has really been an AI beneficiary now. Google Gemini has taken over ChatGPT. It's just as good, if not better. I actually prefer Gemini over every other model right now. Let's see, Google in talks with SpaceX. If you didn't know, here's why I suspect Google's in talks with SpaceX for orbital data center. Google owns 8% of SpaceX. It's one of their best investments ever. Google's actually up over 100x on their SpaceX investment from back in 2014. Google unveils Google Book AI-powered premium laptop. Cool. Alphabet, Google integrate Gemini. Okay, well, anyway, let's just go look at the fundamentals here. This is an ETF in one. You get exposure to AI, advertising, social media, cloud. Yeah, the Google cloud business. Holy moly, you won't believe how fast this is growing. Anthropic just committed to spending $200 billion on the Google cloud and on Google's TPUs. So Google's almost like a mini NVIDIA selling their own chips now. But yeah, the Google cloud year-over-year growth rate at the top grew 63%. That's the highest growth rate on the whole screen. It's one of their growthiest businesses. They also own Waymo. They're in quantum. So revenue grew 21% year over year to 109 bill. And check out, well, they had a slight one-time adjustment. They didn't actually make 62 bill in net income. That's the after-tax number. They had a realized gain on SpaceX. But before that one-time adjustment, they really did make the most profitable quarter ever, $39 billion. If we just zoom out, never even been close. So 39 bill, I'm just super impressed with Google. It's one of the best companies I've ever analyzed. There's not like any other companies I would like trust more than Google in terms of a balance sheet. Like they're spending crazy. That's one thing being questioned. Google spent $64 billion just this quarter, which is more than they're making. So they're spending more than they're making. But they just don't want to be caught behind in AI, and they're definitely an AI winner. So I'm not selling my shares of Google, even though I'm up a bunch. Hey, Plasma, dude, thanks for the gifts there. No way, man. I appreciate you. Yeah, hey, someone said XRP. That's not a stock. I wish I could give you thoughts on this, but this is a crypto. I actually don't own any crypto, but I know out of all the crypto, and I've done no research on this, but I heard like Ripple or XRP has a real like utilitarian purpose to it. It's like has a utility purpose to it more than other cryptos. I don't know, but yeah, I don't own any crypto. The cool thing about crypto is they don't report earnings. There's no like net income or net margin they can miss on, so it's kind of like a catalyst-free asset, kind of like Bitcoin too. Hey, what's up, Plasma? Thanks again for the 40 chili peppers. No way, dude. You got a stock you may look at. Definitely let me know there. So Ramen said Meta. Actually, let's do Meta. And then I want to get to, I saw another stock I wanted to get to. I, again, apologize if I'm missing out on some. Oh, BlackBerry, I think it was. We'll try and get to that one. And what's up, AJ and DTAP? I'm stuck. I did my first 7-day call on NVIDIA. Oh, dang. I wish I could help you out there. That expires tomorrow. First time ever call option. Don't know what to do. Maybe you can call your brokerage and ask him to reverse it or something. But yeah. Hey, what's up? Sori says, hey, Nathan, I feel like the market might turn bearish just based on the news sentiment. I think I don't have enough knowledge. What are your thoughts? Hey, I'd believe it if the market goes red next week or short term. But I know in the long term, I can tell when the stock is undervalued, and that's what we're kind of trying to figure out right now. We're trying to find some stocks that are undervalued, and I don't know if it'll recover in a month or 2 months, but I know long term, well, not financial advice. So I can analyze some undervalued stocks. So here's Meta right here. Meta is, I think, a really good deal right now if you want exposure to like social media. They're one of the best social media stocks. Don't buy Snapchat, Yelp, Pinterest. I'd buy Meta, the one that owns Instagram and Facebook and Threads, WhatsApp, Messenger, and they're just now introducing ads onto Threads, which has now the same amount of daily active users that X does. But yeah, all this behemoth, Meta trades at only 19 times next year's net income. Oh, and check out their active users. They literally have pretty much half the world on a Meta app once a day. They have 3.54 billion daily active users. So, I mean, that's ridiculous. And here's the profits right here. I mean, the most profitable they've ever been this past year for sure. That's what you want to see for a growth company where the net income just continues to climb higher. And it grew 30% year over year. Look at the revenue growth rate. This was most impressive. The organic revenue grew 33. That's the highest growth that they've had in years, 33% revenue growth. Looks like their investments are really paying off, but this is also why people are questioning Meta. They have a net debt position for the first time ever in their history because they're spending more than they're making now. The past 2 quarters, they literally spend 35, 34 billion just these past 2 quarters. And, they only make 20 to 24 billion a quarter. So they're spending like 10 billion more than they're making. So there's like a free cash flow problem. But I like what they're doing. I don't mind them spending so much on AI. That's not scaring me out of Meta. I love what they're doing with the Meta Ray-Ban glasses. Oh yeah, Meta collaborates with Qualcomm and with OpenAI on AI wearable hardware. So they're not only doing Meta Ray-Ban glasses, they're now getting into a smartwatch. Pretty cool. Looks like there's some litigation issues, but that wouldn't scare me out of Meta. And full disclosure, I do own Meta. And no way, Jennifer, thank you very much for that super chat on the YouTube stream. I really appreciate you. If you have a stock you'd like me to look at, definitely let me know. You just made my Sunday. So anyway, here's my Meta position right here. We stream every Sunday this exact same time. If anyone likes to hit the follow button, I sell nothing. And hit the like button too, that'd help me out. But yeah, we're up only 15% on Meta, so not like some crazy returner. All right, so next up, I love buying Google right now. Hey, nice, AJ. So thoughts on SanDisk. So yeah, this is your memory shortage play. So the cool thing, next year is supposed to be peak net income. So I've looked at a price to earnings growth ratio, and they trade at like a 10 peg ratio, which is actually extremely expensive. Here's why, they're not expensive for this next year, though. Here's the thesis. Did you know that SanDisk only trades at 8.4 times next year's net income? here are the actual projections you can see for yourself. They're literally supposed to make 5 billion in net income next quarter and then 6 billion of net income the quarter after. So this from 1 year from now, they really only trade at 8.7 times next year's net income. But when you do like a couple year out net income multiple, because this is a cyclical, it's RAM, memory, SSD, NAND, NAND, which keeps the memory and stops you from hallucinating. This is in such shortage right now, but there's a lot of growth this next year. But I would be careful buying in today. But it's hard to be bearish when the forward PE is only an 8.4. You know what I mean? So next up, what is GRND? Grinder. Okay, I didn't even know this was a stock. Okay, so $2.3 billion company. I remember they were trying to like sell their business or something. I don't remember, but they are net income positive. Wow, that's actually surprising. So this stock really does make like 20 to 30 million of net income a quarter, and they're projected to continue to make that. 27 mil next quarter, 28 million the quarter after. So this company, in terms of net income, only trades at 20 times next year's net income. So interesting. They are a bit leveraged, the same amount of liabilities as assets. But I mean, when you're making 30 mil a quarter, maybe it's all right to pay off. I don't know. I'd be careful with this one, it's like a dating app, but that's what this is. So, what is it called? Match Group. That's what it is. Match. This is the people that own like Tinder and stuff. Yeah, dang, look at their stock. Their stock is the same price that it was in 2018. How is the valuation? So they trade at 12.6 times next year's net income. So there we go. How's Tinder growing? I guess so. It's not doing too hot. Anyway. Next up, BlackBerry. Yeah, I know, Grail. I didn't even know that stock was public. So next up, I saw BlackBerry. Oh, actually, or Nokia. I always get those two confused. There's BlackBerry and Nokia. They're both like old phone companies that lost to Apple. Out of all the phone companies, actually, I see Nokia and BlackBerry in the chat. I actually prefer, if I had to buy one, I would pick Nokia. And by the way, here's NVIDIA's portfolio. If you didn't know, NVIDIA's so big, they individually own some stocks. They own Intel, CoreWeave, Coherent, Synopsys, and then they own Nokia. And then they just bought G and B. We were doing analysis on this earlier. Absolute hunk of junk. Don't buy this. Just like their old RXRX investment. It was all right. Anyway, Nokia has had a lot of positive momentum. When you think of Nokia, you think of the phones a long time ago, but this is no longer a phone company. Yeah, look at this stock back in the year 2000 when they were a big smartphone company. They were $52 a share, and now it's $13. But it's had a massive recovery these past couple months on an NVIDIA investment and a net income recovery. So if we just go to net income projections, these are actually very good. They're supposed to make 260 mil of net income next quarter, 390 million of net income the quarter after. So they're genuinely making a couple $100 million in net income a quarter now, and it's supposed to stay that way. And I believe they've gotten into this data and cloud business, and that was their growthiest metric year over year. Let me see if I can find this in the analysis. Yeah, check out the second line here. Their AI and cloud related business sales increased 49%. So that's why the stock's done well on momentum, because the actual fundamentals are growing. Their AI and cloud business, and that generating approximately, this is a European company, 1 billion euros in new orders. So pretty cool. Yeah, we've converted the currency from euros to US dollars. So these metric we have been looking at is in US dollars. We've converted it. So yeah, cool. So it's some sort of no longer a smartphone play. It's now like a infrastructure play, like cloud or something. Wrong. BB is into AI, not cell phones. Yeah, that's what I said. Ford, please. Yeah, hey, MJ. Unfortunately, I don't love Ford. Technically, Ford is lower than they were in the year 2000. So in the year 2000, Ford was $25, and now it's $13. They just struggle with like profitability. They just sell a commodity, a low margin commodity. Oh, hey, when I got this brokerage, they gave me a free share of Ford and I sold it. Hey, if you'd like to get this app and get a free share, I have an affiliate link in my bio there. But anyway, Ford right here, how are their vehicle deliveries? So vehicle deliveries are down 4% year over year. But yeah, look at this net income right here. Gee, it's actually gotten better. But yeah, if we go to net margin right here, just kind of like a low margin commodity. You know what I mean? Low single digit, lots of competition. Let's see, how are Morningstar valuing this company? I would be curious. So they actually, Morningstar says they're undervalued. Consistent improvements in structural cost management, robust performance in the high margin Ford Pro commercial segment, and a pragmatic pivot toward hybrid and profitable internal combustion vehicles will drive long term value recovery. Well, that's good news. Well, that's good. But do I expect this company to, on average, outperform the S&P 500 from now on? Probably not. The same way it hasn't for history. So I would be careful with Ford. It's kind of like a dividend play. I think they have like a 5% dividend yield. Yeah, so Little said Rivian stocks. The thing with Rivian is, yo, Nathan, what's the best electrical infrastructure play? Powell, maybe? Ooh, that's a good question. We'll check that out later. And I'm so behind. What's up, Sagittarius and YouTube agent? Gabriel, Norbero, Devra, Matt. Good to see everyone. Oh yeah, Berkshire Hathaway will do too. Okay. How is Morning Star rating their own stock? Oh yeah, Morningstar is publicly traded. So here's Rivian right here. The biggest shareholder is actually Amazon. So what's cool is, has anyone seen those like electric Amazon delivery trucks? They look so cool. And oh, Amazon's no longer the largest shareholder. Porsche took over. That actually happened as in like, if we go to last quarter, yeah, last quarter, Amazon owned 12. Porsche owned 11. Now, as of the latest quarter, Porsche owned 16. And Amazon increased their position as well. Amazon owns 12% of all the shares. Anyway, it's kind of the same boat as Ford is. Well, they're actually a little worse off than Ford. They are far away from profitability. I mean, if we just go to basic metric here, net income, this is the scary part. They lose a lot of net income every quarter. They're losing like 500 million to $1 billion a quarter. And the losses are supposed to persist. They're supposed to lose 999 mil next quarter, 998 million the quarter after. So they're basically losing $1 billion of net income a quarter, which is tough when your whole company's worth 18 billion. So there is no forward PE to really value this company. Morningstar does say they're undervalued, but it's just tough. There's a lot of competition. It's a commodity, you know, Tesla. But I do like the Rivian trucks and the Rivian Amazon delivery vehicles. Do you think Amazon might even fully buy them out one day, which would be interesting as like a robotics manufacturing play. All right. Next up, we got, hey, Larry, dude, thanks for becoming a super fan. I appreciate that. What app? Yeah, hey, app is LinkedIn Profiler. It's just this is actually a brokerage called Moomoo. I saw Take-Two do GTA 6 stock Take-Two. So yeah, it was actually just leaked. Does anyone like GTA 6? It was just leaked that it's about to be released, and this is for real. Check this out. This is in the news. The second line here. Leaked Best Buy materials suggest GTA 6 physical pre-orders may begin May 18th. Today's May 17th, so we'll see what happens tomorrow. But anyway, I think most of the growth is fully priced in because the bad part is the stock is really expensive, like super expensive. If we go to a forward PE, they're trading at 120 times next year's net income. They're in a cool position because they're going to release a game. They're like no other company is really in this position where as soon as they release this asset, this game, it's going to bring them in billions of revenue and hundreds of millions of future recurring revenue with this GTA 6 release. But the bad news is their current financial condition. Here's basic net income metric here. Look, they have not made a single dollar of net income since 2022. All they've done since 2022 is cumulative lose over 10 billion of net income. So that's the one scary part. They're still pretty far away from profitability, but look at this. They're supposed to narrow their losses to only 37 million. That's the only scary part to me. Some other great game companies like Microsoft. Microsoft owns Minecraft, Candy Crush. They own Activision Blizzard. Microsoft is a really cool video game company as well. Candy Crush, Minecraft, the Minecraft franchises, they're up crazy on their Minecraft investment. They bought Minecraft for $1 billion, and it's arguably like just that is worth over like 50 billion itself. Yeah, and they own 28% of OpenAI as well. Microsoft's a steal of a deal. I really believe that. Oh yeah, another game stock. Someone said, "Can you look at Unity?" So I love you, or I don't love the stock. I love Unity, the platform. I have it. You know, that's the platform that made Rust, my favorite video game ever. So the bad part is, it's just another one that I just can't stand. These money losing companies. It's just hard to really trust. You know, they lose over 100 mil in net income a quarter, 350 mil this quarter. The growth is finally coming back because if we go to last year, look at these year-over-year negative revenue declines. But now the revenue's finally back to positive after we're comparing from the decline. But yeah, it's unfortunately because there is no forward PE on this company either, so it's tough to value. Yeah, 550 times next year's net income. It's because they're just now getting net income positive, and I don't even know if they're going to stay net income positive either. But I do love their platform. Oh yeah, Tencent as well. So Z said Shopify. Yeah, and I apologize. There's so many stocks I want to get to, but I just can't get to them all. Oh, and Larry, remind me to get to AIS. You know what? Actually, no, we'll do AIS real quick. Then we'll do Shopify. Thanks again for becoming a super fan. AIS right here. This is the Artificial Intelligence Super Cycle ETF. Wow. So this ETF has done very well. Look at it the past couple weeks here. It's like straight up. This is an ETF, not even like an individual stock. An ETF is just a basket of stocks. Oh, so it looks like a memory shortage company, with SK, just memory, Micron memory, AMD's the CPU shortage. Oh, Vertiv, they have a data center water cooling play. I've never heard of SIMO. Then they got Intel, Taiwan, GE. Yeah, this really is a good like AI super cycle ETF. And I believe in the whole AI super cycle, electrification super cycle happening. Here are some of my favorite electrical infrastructure stocks. I'm a big fan of electrical infrastructure like Eaton, Simmons, Amphenol, Powell, Corning. And then also I'm a big fan of HVAC, the companies doing the cooling, because these servers will just burn themselves down if not cooled properly. So I like Vertiv, MCore, Comfort Systems, Train Technologies, AAON with the 55% rooftop HVAC market share, Legions, Jabil, Madison Air, which just IPO'd. So anyway, those are industries like that. That's my main kind of industries. I got Comfort Systems is my main HVAC play. Powell Industries is my complex electrical work play. So Sagittarius said Tencent. Yeah, let's do Tencent. Okay, if you like video games, actually, if you like video games, like Take Two. Here's an arguably better one. This is Tencent. They own, if you didn't know, they own Riot Games. So if you've heard of League of Legends or Valorant, they own that. If you've heard of Supercell, which is Clash of Clans, Clash Royale, Boom Beach, Heyday, all that, they own Supercell. If you've heard of Epic Games and Fortnite, they literally own 49% of Epic Games, which is Fortnite. They own PUBG, PUBG Mobile. I mean, the list goes on. This is a Chinese company. If they were an American company, this would replace Tesla as a Mag 7 company. I legit love this company. They only traded a 15 forward PE, so 15 times next year's net income. So, and yeah, here's their net income right here. And this is in US dollars. They're making like 8 to 9 billion of after-tax net income a quarter. So pretty cool. And they're on a dip like most Chinese stocks right now. But I just love the things they own. Cheap valuation, good net income. You get a dividend. So cool. I got 16K on Fidelity. Hey, dude, great, man. Yeah, no problem, Larry. Your future self will thank you for investing. The goal with stocks is not to get rich quick. It's to just slowly build and preserve wealth. It's to get that 10% a year. So you turn $100 into 110, then the year after it compounds, it snowballs. It goes from 110 to like 128, then from 128 to 160, and from there as you reinvest the dividends and deposit more slowly. So you too. Oh yeah, Berkshire Hathaway. Yo, I am just so behind. So Berkshire Hathaway. This is Warren Buffett actually no longer is like the CEO of this company. This is Warren Buffett's kind of company, which is weird is, I don't know if I like this. They actually bought, here's what they did. They completely sold out of Visa. They completely sold out of, we had a list of it. Oh, I don't know if I should show this right here. We were looking at the list earlier. Oh geez, hold up here. So yeah, look at this. So Berkshire Hathaway, he added Delta Airlines and Macy's stock, and he sold at the top. He sold Visa, Amazon. He fully sold out of Visa, MasterCard, Amazon, Domino's Pizza, Formula One. He sold out of these incredible companies. And what did he buy? Or it wasn't Buffett, it's the new managers. They bought Macy's and Delta Airlines. I mean, come on, man. I don't know all about that. Oh, looks like they did triple their Alphabet position. I do like, actually, let's go see what they did exactly. We have the data. I forgot about that. Because this is yesterday's data. Let's see if it's already updated. It is updated. No way. So yeah, here it is. The new positions. Macy's, Delta Airlines sold out of. He sold out of Pool. Lamar Advertising? No. Anyway, I don't know what they're doing, but here's their actual portfolio. Apple, American Express, Coca-Cola, Bank of America, Google. Whoa. Google before today was 1% of their portfolio. Now it's 6.9%. Now that's interesting. They really did triple their Google position. Anyway, it's basically just an ETF. You sound like Owen Wilson. I don't know who that is, but that's funny. But anyway, it's like a S&P 500 alternative. They own a bunch of stuff. They're very diversified. So they own a bunch of stakes. As we saw, they own like a stake in Apple, Bank of America, Coca-Cola. But then they wholly own some companies. They wholly own Geico, Pilot gas stations, Dairy Queen, BNSF Railroad. What happens is, hey, this is actually a brokerage. It's where you buy and analyze stocks on. They ask for a bunch of information and stuff. But if you'd like to get this brokerage, I have it linked in my bio there. It's an affiliate link, brokerage called Moomoo. So, Can you look at TBBB? It's a Mexican grocery store. Let's check it out. So BBB Foods. So hey, they've done pretty good. So maybe it's like where they headquartered. Yeah, so they are a Mexican company. So we'll convert their company from pesos to USD to get a better idea of what they do. Actually, let's go to their website to see what their actual website is. So TBB. Okay, so it's not in English, but yeah, looks like they maybe it's like a grocery store, convenience store kind of thing. Cool. Anyway, let's go to their financials because that's what matters. Let's analyze the financials, and we're looking at US dollars now. So the revenue grew phenomenally. Whoa. Revenue grew 52%. That's a record quarter. 1.28 bill of revenue, but I did notice they lost 1 million on that. So that's the one weird part. They used to make consistent net income back here, 14, 20 mil a quarter, but now for the past 3 quarters, it went negative. I wonder if it's from an acquisition. That's what I suspect. No, no acquisition. So either that or they're just opening up a bunch of new stores. Like that's really impressive. The organic revenue is up 40 or 52. I mean, revenue's up 52 and it wasn't from an adjustment. Yeah, the revenue's supposed to continue to climb, huh? Anyway, cool. All right, next up. Wow, you're awesome. Hey, thanks, Midnight. I appreciate y'all. They're investing in dividend stocks. Oh yeah, Berkshire Hathaway. Yep. And what's cool is Berkshire Hathaway doesn't pay a dividend, but they just do share buybacks instead. So, Plasma said, I like SoFi. Let's check out SoFi. This is one of my favorite fintech growth stocks, and I do own this one, full disclosure, but I own them for a reason, and I'm about to buy more shares. Here's my thesis behind SoFi right here. So the metric you want to really judge SoFi off is their main growthiest metrics. First off, their lending revenue. Largest segment business, that grew 55% year over year. After grew 25. So that's the growthiest metric on the whole screen. Revenues up 55% year over year. And not just the lending revenue, but also their financial services. That grew 42, after grew 101, after grew 86, after grew 195, after grew 290. So they're on an absolute streak of growth on their financial services and on their lending business. So all the businesses combined, organic revenues up 42% year over year to a record. You know, if you're going to diamond hand a growth stock with no dividend, you want to make sure they're growing like crazy, and they are. Revenues up 42% year over year, not just revenue, but the net income as well. They're genuinely making a couple hundred mil in net income a quarter. And the analysts are real bullish too. They see net income going to 240 million in 2 quarters. It's never even been close to 240 million before. So, yeah, that's why I really like SoFi. And if we value them off next year's net income, and that's how you would value this stock off next year's net income, they're legit cheap. Like, not financial advice, this is a cheap company. They're only trading at 21 times next year's net income. So if you wanted SoFi as 5% of your portfolio, I wouldn't make SoFi 5% of my portfolio today, but I'd go ahead and make it like that 1%. You know what I'm talking about? So, hey, Cuts, dude, I appreciate that gift there. Good to see you. So I saw someone said GSG said Palantir. Thoughts on Palantir? One of my favorite stocks. And then we'll look at hey, what's up, Sheldon? We'll look at QQQM. That's the cheaper QQQ. I love that ETF. And then we'll look at LEU. What's up, World Free Speech and Else? What's your opinion on? Hey, we'll check these out too. Yeah. And Louise, shout out to member Louise on the YouTube stream. Good to see you, man. How's your Sunday going? So here's Palantir. They're on a slight dip right now, so it actually makes an opportunity to maybe buy some shares, but I wouldn't go crazy yet buying shares because it's still expensive. Hey, speaking of, what's your opinion on the Trump trades? I guess this is one right here. It's like the president purchased 630,000 in Palantir stock, publicly endorses defense company. So anyway, is there any Ukraine's President Zelensky meets with Palantir? I don't want to get into politics, so let's just go look at the actual fundamentals here because a lot of this company's revenue does come from the government. 53% of all the revenue comes from the government, but look how the government revenue is growing. It grew 76% year over year. After grew 45, after grew 10. So the growth rate is growing year over year. So 76% on the government, but look at the commercial side. This is actually the growthiest business. That grew 95% year over year. That's incredible. It's up 95, after grew 33, after grew 27, after grew 11. So another one that's just growing its growth rate. And they're crushing analyst expectations. This orange line is what the analysts expect. They expected 616. They did 870. They're the most profitable they have ever been. And they have a monster balance sheet. Palantir is actually debt-free. They have no debt at all. So yeah, pretty cool. I love Palantir. But actually, the one thing I don't love about Palantir is that they check all my boxes. Fortress balance sheet, industry I love, beating expectations, money printer, expanding margins, S&P, but expensive, 87 times next year's net income. and they trade at 61 times sales. So not 61 times net income, but 61 times their revenue. So it's a little expensive, but they deserve to be expensive because of how growthy they are. I'm impressed. Micron, SanDisk. Yeah, back to Micron. I'll be quick about this one. Here's the thesis here. When we value them off next year's net income, these memory stocks really are inexpensive. So check this out. If like simple metric here, next year's net income, they only trade at 7.7 times next year's net income. That's why it's hard to be bearish. And here are the actual net income projections. Next quarter, analysts expect them to make 22 billion and then 26 billion the quarter after. That's annualizes 100 billion in net income a year. And the company is worth 800 billion. So yeah, they really only do trade at 7.7 times next year's net income. But it's really a supply chain. Will the supply chain fix? Because next year is supposed to be their peak ever earnings. Then they're going to go back to, as the supply chain fixes itself, lowering their margins. But during this next year, they're going to basically have 100 billion in net income and free cash flow to play with. And what are they going to do with all this? So yeah, it's your this is your memory shortage play. Samsung workers threaten 18-day strike, potentially disrupting 3% of global memory chip production. So that's even more issues. Global memory chip prices surge over 500% year over year as AI demand drives historic supply shortage. So you can see why these stocks are doing so well, and it's tough to be bearish. So, but I wouldn't exactly buy anything, buy into them right now. All right. So, Caspa? Dill, what is Caspa? Please give me the ticker symbol for that one, and we'll check it out right there. I see, NU. Yeah, hey, Jet, this is a great Brazilian crypto bank. So if you want exposure to crypto, but not exactly like a cryptocurrency, but just like a pseudo crypto play, NU is a phenomenal play in my opinion. This is a crypto bank out of Brazil. So if we go to where the revenue comes from, 91% of all the revenue comes from Brazil. They're actually they're a Brazil bank, but they're actually applying for their U.S. banking charter right now. And someone actually recently said they're seeing ads there, ads in the U.S. for their new bank. So maybe they're about to get approved. Who knows? But the coolest part about this company is, and this is in US dollars as well, y'all won't believe this. This is the most impressive part about this company is the money they print. They really do. They're genuinely a money printer. Here's their net income. And this is real. They made 870 mil in net income this quarter, 900 mil last quarter, 800 mil last quarter, 600 mil. So it's up 56. Like these year-over-year growth rates are phenomenal, and the growth is not done. And let's start projecting 1 billion in net income next quarter, and then over 1 billion in net income the quarter after. So they're going to be making 4 bill in net income a year. And when your whole company is worth only 60 billion, yeah, they only trade at 12 times, or what's the exact number? 13 times next year's net income. Seems pretty fair to me for the growth that they're experiencing. It looks like, wait, what is this right here? Increase Lone Pine Capital increases NU stake. Okay, cool. Anyway, I'm a fan of this one. They really do print money. And yeah, down there in Brazil is where people really use crypto for transactional purposes. So how about Grab? Yeah, Grab. This is like an international Uber. One of my most recent purchases, like my second or third most recent purchase, is Uber stock. I love Uber. They're kind of like the orchestrator of this new AV autonomous vehicle play. So Uber, I just bought 12 shares of them. Uber is actually the largest shareholder of Grab, and it was their way to get exposure to this universally needed ride-sharing commodity. And Grab is the international play. So if we go to, again, they do exactly what Uber does, ride sharing and deliveries, but in these other countries. Notice the US and Canada isn't on here. It's Malaysia, Singapore, Indonesia, Philippines, Thailand, Vietnam. So all these like more nichier international countries, it's what makes them unique. So if we go to the largest shareholder, Uber is the largest shareholder. They own 13% of all the companies. So yeah, it was their way of getting exposure internationally. And Toyota Motor as well owns 5.5% of all the shares. So it's good that they're backed by some quality people. Uber wants to see them do good. And they're also the most profitable they've ever been. That was a huge game-changing moment for me because a year ago, you couldn't really buy the stock. But now, they actually print money. So yeah, look at a year ago. They were kind of losing money every quarter, losing 100 mil a quarter, then it narrowed. But now the company's making, I keep swiping over on accident. Now they're making over like 100 mil a quarter. So plus a really good balance sheet. So there you go. And what's the valuation? They're probably still expensive, but this is because they're just now getting net income positive. Yeah, they're trading at a 31 forward PE, but you really want to do like a 2 or 3 year out forward multiple. Director bought, Oh, Caspa's a crypto. Yeah, hey, I wish I could cover that for you. We don't really cover crypto on this stream. Yeah, I wish I could view that for you. Or is it this right here, Kaspi.kz, KSPI? Is this what you're talking about? Huh, let me know what you're talking about because I don't know if I can find that one for you. I apologize. So Michael said, oh, then we'll look at Alibaba after this. A director bought 70,000 shares of PLTO. Let's check it out. PLTO, I think it's, wait, PTLO. I'm like, I can't find that one. So Portillo's, I think this is like a restaurant or something right here. Let's go to their website to remind us. So yeah, they're in the restaurant industry. So let's see. I mean, hey, this stuff looks good right now. I've not eaten today, so this stuff is looking really good. You know, chicken sandwiches, so all this kind of stuff. Cool. So let's go see how the fundamentals are doing. So revenue, and again, a lot of restaurants are struggling right now. So the revenue grew 3.5%. So the revenue's up 3.5, but the profits fell by 36. So look at that. Revenue is growing, but the profits actually fell. So that means the margins are going down. So yeah, the net margins fell. So I so a director did just buy some shares. So the forward PE is a 17. That is a cheap valuation. McDonald's, for example, is at a 20 forward PE. So it might make more sense to buy McDonald's. And as we see, this is a restaurant stock on a big dip right now. It's not just them that's on a dip right now. It's a whole industry problem. Look at Wendy's stock. If you bought Wendy's in their 1997 IPO at $14 a share, you're down over 40%. It's $8 today. Cracker Barrel, Red Robin, Krispy Kreme, Jack in the Box. Look, they're the same prices they were in 1998, and also on this huge recent dip. So I feel bad for these restaurants. And out of all the restaurants to buy, probably the most resilient one, the best one to buy, the qualitiest one to buy for sure would be like a McDonald's. Because really, they're not exactly a restaurant. They're a real estate and royalty company because McDonald's owns the land under 80% of all the stores, and they collect a royalty. So someone said, can you check out Spotify? Yeah, let's do Spotify. And then we'll look at Michael, keep in mind, or Michael Burry. Oh yeah. Virgin Galactic. I haven't heard that stock in a while. That one, I don't know. That's like super far away from profitability. And yo, Junior, man, yeah, we'll do VG and Zeta after this. Sorry if I'm a little behind in the chat. Again, hey, if y'all want to hit the follow button, subscribe button, I stream every Sunday this exact same time. I literally sell nothing. I have no course book, WhatsApp. I'll never follow you, DM you, nothing like that. Just on here, give my opinion. That's not financial advice. So here's Spotify. It's a subscription model company. Most of the profits actually go as royalties to Universal Music Group, you know, paying people like Taylor Swift. But then they keep, say like 60% of the revenue goes to them, but then they keep a good chunk from their subscribers. So, yeah, they have 293 million premium subscribers. So 293 million people are paying for Spotify Premium. And check this out. Actually, we should really look at the operating profit. They're the most profitable they've ever been. You know, back in 2021, you know, they were far from profitability, losing a lot of money every quarter. But now this is genuine. They're really making like 800, 700 million a quarter. So, and at this growth rate, what's it going to be the same time next year? They are expensive, I believe. Or let's go check out the valuation. Actually, not really. So Spotify trades at 28 times next year's net income. Interesting. So they say they're fairly valued. Consistent subscription price increases, expanding margins. Cool. So yeah, they have like their main. They just made their ad-supported tier a lot better, I heard. But anyway, yeah, it's a subscription model company. I like what they're doing. Tencent actually owns 8% of all the shares. That Chinese company. Yo, Tencent. We were analyzing them earlier. They own 10% of Snapchat, 10% of Spotify, 10% of Yelp, 10% of Reddit, 10% of Snapchat. I mean, they just own stakes in all these US companies. VG oil stock. What's this one? Venture Global. I think this is like a natural gas production or under production company in like Louisiana. Let me go to their website if I can figure out where they are again. Oh yeah, so basically they have these huge LNG products. Okay, can we not get that video? There we go. So yeah, here are like pictures of what they look like. Yeah, in Louisiana. Yeah, the Plaque mines. Okay, and here are the actual mines. Lake Charles, kind of close to Houston. All right, let's go look at their fundamentals here and the future expectations because I believe one or two of them are still under development. See, actually, they're cheap. They trade at 9.5 times next year's net income. So that's actually cheap. Maybe that's reasonable for like an oil and gas or an LNG stock. So yeah, the Plaque Mines project. So let's see. Yeah, net income is phenomenal. The projections are supposed to make $1 billion in net income next quarter and then $1 billion in net income the quarter after. and they had a big beat on earnings this quarter. So they expected 3.84 billion revenue. They did 4.6 billion. And maybe with all the recent oil Strait of Hormuz being close and stuff, maybe they'll even have better margins than expected. So anyways, it's a LNG play. They really do print net income. They're making over $1 billion of after-tax net income a quarter and a 9.5 forward PE. Seems pretty reasonable. Portillo's food is so good, it's very pricey though. 3 burgers and fries was $55. Dang danky. I didn't know that. I own a little PTLO though. Food is great and it's always busy. Cool. Anyone else wish Chick-fil-A went public? That'd be kind of cool. I wonder how they'd be. So Bloom Energy, I see. Oh, wait, let's do Zeta. No, I saw that one a while ago. Let me do Zeta. Then we'll get to Bloom Energy and GE Vernova. I see a lot of these I want to get to. And again, I apologize if I'm missing out. There's just so many stocks I see right now. So here's Zeta Global. It's a software company. They just acquired Marigold Advertising, which is a cool company. Morningstar says they're undervalued. Yeah, look at these revenue expectations. Revenue's going year over year from 337 to 460. So that's incredible revenue growth they're about to experience. And they're finally going to get net income positive. So look at this. If we go to current net income, it's kind of choppy, lost money this quarter, then made money last quarter. But they're very close to staying consistently net income positive, and they're going to make $9 million in 2 quarters. So you're basically buying this company as they're getting net income positive for the first time. So so there really is no forward PE or 165 times next year's net income, but that's because they're literally just now getting their first ever EPS. So really want to do like a multiple year out forward multiple. So it's kind of tough to value this one, but they are having phenomenal revenue growth. 330 to 460, potentially from acquisitions, because they're doing a lot of acquisitions recently, which I like that they're doing. Is there any specific news? Let's see, weekly news. No news. Dang it. All right. Oh well. But yeah, they're cool. What? Oh yeah, what was it? Oh yeah, Bloom Energy. This is like an alternative energy business right here. Let's see, was there any news? Is there really no news? There's always news around Bloom Energy. Oh well. Well, they were down 9% on Friday. So can we get like an earnings recap? So product revenue growth was explosive, particularly driving from data center and AI infrastructure demand. So it's some AI infrastructure play. Overall revenue up 130. Wow. So let's go see what the earnings were. Analysts expected 540. They did 750. There's no wonder they're at all-time highs. It's not just momentum. Like, they really are crushing expectations. Yeah, they gapped up on earnings. I can now see why. Because analysts expected 540 and they did 750. And not just beat on revenue, but they were expected to lose 600,000, but they made 70 million of profits. So yeah, they definitely deserve to go up. So yeah, revenue's up 130% year over year. That's pretty cool. Let's go to their website. Maybe we can find out a little more about what they do. Is it just like data storage? Okay. What is this? Zero water. Okay, so I guess here's their actual batteries or something right here. Ultra reliable. Well, cool. There we go. Bloom Energy. I probably wouldn't buy it at all-time highs though, but I can totally see why they're doing so well. So, can you look at ARKX? What's this one? ARKX, the Space and Defense Innovation ETF. Cool. I bet this one's rallying because of the SpaceX IPO, the Artemis 2 mission launch. A lot of these space companies have had positive momentum. Yeah, like a Rocket Lab, Kratos. There's really not. This isn't really much of a space company or defense. I mean, it has AMD, Teradyne, John Deere, Amazon, Archer, Google, AeroVironment. So it's not much of a space and defense ETF, but it's done great. It's done great. And actually, I'm a fan of its holdings, even though it's not a pure play. I like all these holdings in here. So, well, not all of them, like Archer Aviation and Rocket Lab's pretty expensive, and I wouldn't buy those. But overall, that's nice. HEMS, ooh, yeah. Actually, let me do GE Vernova. So I think you'll like this one more. Then we'll maybe get to HEMS. That one is tough. It's a Cathie Wood fund. Yeah, kind of lost a lot of respect for Cathie Wood because her main ETFs have done so bad. But we'll actually check out more of Cathie Wood after this. So here's GE Vernova. This is for context, under every data center are these 2 basically turbines that are backup. Well, yeah, look at this. GE Vernova sells out of gas turbine production through 2030 with the 100 gigawatt backlog, which is like a couple $100 billion worth of backlog, which is ridiculous. So yeah, under these data centers are these gas turbines that whenever, if for whatever reason the electricity grid went down, these are the backup generators to keep the data centers running because these data centers can't afford to go down or be offline. So yeah, GE Vernova, Morningstar says they're reasonably valued. Its leading position in gas turbine markets and strong tailwinds from the multi-generational electrical supercycle will drive long-term value growth. Yeah, the tough part is the valuation, a 55 forward PE, so 56 times next year's net income is too hard to pay, but they're really, sold out through 2030, huge backlog. I can understand why they're at all-time highs. They deserve it. Next up, oh yeah, let me do Hims. They've kind of just lost to Amazon. So you go to Hims and Hers website to pay for your weight loss prescription or your what is it? What's like hormone prescription? I don't know. That's what they're mainly into right now. Anything you can get on them, you can really get on Amazon as well, and that's been one of the biggest fears because basically Amazon is a mini Hims and Hers in one. So yeah, the growth was questionable because it was led by an acquisition. They just acquired a company called Eucalyptus Therapeutics, and even with that acquisition, the revenue only grew 3.77%. So the revenue grew 3.77, but look at this, the net income went negative, and this was real as well, like real operating losses. Like that's the first time they've ever really lost money. They used to print money back in 2024, 2025 when there was no legal issues. They were selling Ozempic and Wegovy for a high margin. Then they got into the litigation issues. Then they were no longer selling. This is why the stock is at so much volatility. Then they no longer sold Ozempic on their website, their highest margin product. So the margins tanked. And then they released their own knockoff weight loss prescription. Then Ozempic sued them for doing the knockoff. And then finally, Ozempic is back on their website selling for a much lower price, and they keep a fraction of the margin. So it's tough. So, yeah, speaking of Cathie Wood earlier, so that being said, and also Hims isn't cheap. If we go to a net income or actually a next year's net income multiple, they traded 180 times next year's net income. Or let's see the net income projections. It's the scary part. Like they used to make such good net income. Now it's like, dang, they're supposed to lose 18 million in net income next quarter and then make 21 mil the quarter after. So that's why I'm staying away from Hims. That's the scary part for me. So speaking of Cathie Wood, yeah, here's the Cathie Wood portfolio down here. Here are all of her, or she has a bunch of ETFs, ARKK, ARKG, ARKW, all these ETFs right here. But yeah, here's her overall portfolio, Tesla, then AMD, then Circle, Robinhood, Coinbase, Roku, CRISPR, and then Shopify, Palantir. I love those two. Shopify is great. So TMO, what's up, Paul? We'll do Thermo Fisher, and then we'll do Rubrik. What's up, Eric? We'll do Rubrik. What's up, James? We'll do MXL and PGY. Yeah, PGY, that's like one of the cheapest software stocks. I couldn't believe the low forward multiple there. So, and then we'll look at CEG. Yeah, y'all got some good recommendations here. So here's Thermo Fisher. I can kind of understand why this stock is the same price that it was in 2020. So unfortunately, this stock has done nothing for 6 years, or it's been flat since 6 years ago. And that's because the profits are kind of where they were 6 years ago. So yeah, if we just zoom out to net income, here's the year 2020. They were making, more net income than this past year, actually. As you can see, it's kind of slowly declined. So that's why this market cap hasn't been able to escape this level, and the stock has been flat for 6 years because they're making the same amount of yearly net income. So why would they get traded at a higher market cap and higher multiple? They're not. So that's why the stock's been flat, but they still print money. It's not like they're going bankrupt. No, if anything, they're still printing 1.6, 1.9 billion of net income a quarter. It's like a testing company. Yeah, laboratory products, life science solutions, specialty diagnostics for companies like AbbVie to test their prescriptions. Yeah, it's just kind of experienced like very low net income growth to the point where actually the net income is lower than it was in 2021. So that's what we want to see. We just kind of want to see the growth come back. And then I think this one will finally start to have stock price appreciation. Dang, yeah, it's on a massive decline. Maybe all the bad news has been priced in because they're at a 21 forward PE. Morningstar says are undervalued despite near-term headwinds and softness in the China market. Its unmatched one-stop-shop product portfolio and deeply entrenched position in biopharmaceutical supply chain will drive long-term value growth. What's their China revenue? Oh, so look at that. I didn't even know that. So actually, probably most of the revenue is international, coming from countries like China. And then the U.S. is 49% of the revenue. So they have more money coming internationally than in the U.S. So hopefully that was kind of helpful there. It wasn't exactly super bullish, but We can kind of understand why the stock has been flat. That's what we try to do. Hey, dude, the artist. No way, man, for the freaking gifts there. I appreciate you. You got a stock you may look at? Let me know, Junior. And then, oh yeah, we'll look at Qualcomm. Oh, definitely. Yeah, we'll look at Qualcomm after this. After we look at CEG, we'll look at Qualcomm, and then I see Circle, Oracle, Rubrik. I'm so behind. I apologize if there's. I'm gonna be live for well over another hour. So if y'all want to hit the follow button, I appreciate that. We stream every Sunday at this exact same time. I saw nothing. So here's Constellation Energy, and I do own this stock. Full disclosure, it's one of my favorite utility companies. I want to own the companies powering the data centers, and right now, I like nuclear. In this company, CEG owns 33% of all the US's nuclear reactors. So it's the pure play for nuclear energy. There is no close second, and it's on a dip right now, so you can get in at a pretty decent time. And look at this valuation. This is the crazy part. They're only trading at 21 times forward PE, or literally 21 times next year's net income. I think that's very fair. That's cheaper than NextEra Energy, who's regulated. So I just can't believe it. Plus, they had the most profitable quarter ever, highest ever sales, highest ever operating profit, highest ever net income this quarter. So from their Calpine acquisition. So I'm not being scared out of CEG. I'm actually looking to potentially buy some more shares of this stock right here. Let's see, but is there like an earnings recap here? The acquisition of Calpine boosted revenue, profit expanded dramatically. Yeah. Net margin increasing. The stock experienced a slight post-earnings volatility, but analysts still consider this one a strong buy. Well, anyway, there we go. Is there any other weekly, or is there any news around this company? Sorry, my phone's a little laggy right now. Constellation Energy reports EPS of 270, affirms a full year guidance of $11 to $12 a share. But look in the very top left. The stock is $267 a share. So here's an easy math. We'll do 267. We'll divide that by 11.5, the midpoint of their guidance. They traded only 23.2 times next year's net income. Oh yeah, look at this. They also, Constellation Energy acquires minority stake in these LNG productions. Constellation Energy projects 11 to 13 billion of free cash flow. So anyway, I like that company. Out of all the utilities, that's my favorite one to buy the dip on. And I do own them, so I might be biased, but I own them for a reason. So anyway, thanks again for the huge gifts there, my friend, artist. He said Qualcomm, or maybe she did. So here's Qualcomm right here. This is a cool royalty and chip company. It's like a smartphone chip company. They're actually partnering with Meta and OpenAI on the second line here on wearable devices. So they're getting into smart glasses and into smart watches, or Meta's making them, and it uses Qualcomm's chips. Qualcomm CEO predicts AI devices will achieve mass adoption, reaching 1 billion units within 5 years. Well, anyway, that they just had really good guidance on earnings. What a lot of people don't know is they own a bunch of patents. So let me go to the Morningstar research to show you this. Read the first line. Read the very first line. Qualcomm collects a royalty income on the majority of 4G and 5G handsets sold, as it holds many essential patents used in these networks. So yeah, they make these smartphone chips that, look at this, they have a 22% smartphone chip market share. And these chips are now going to be used in other things like glasses and watches. So pretty cool. And it's like a dividend growth company. You buy the stock now, even right now, you're getting 1.8% of your money back in a qualified dividend every year. The forward PE is a little expensive at a 29 forward PE, but man, for the growth, I mean, that's normal for like the average AI stock. That's like a cheap valuation, especially if they're going to grow the way they say. So, oh yeah, PGY, man, I am just like behind like crazy. So sorry for everyone on the YouTube chat. Feel free to re-say your stock and I'll get to it. Hey, Brian Paul, no way the member. Hey, shout out him. We'll look at Marvel after this. Yeah, another semiconductor play. That's actually a big partner of Google. Google's TPUs use Marvel now. So here's PGY. It's a software company. I think it's like a fintech software company. Look how cheap they are. They trade at 0.8 times revenue and 7.5 times next year's net income. That's why I'm so bullish. I mean, valuations can just stretch higher. They only trade at 7.5 times net income. Any sort of good news will boost this stock really higher. Here's the net income projections. They're supposed to make 33 million net income next quarter, and then 39 million of net income the quarter after. So when you make 120 million net income a year, that's phenomenal when you're only worth 1.1 billion. You know, that's over 10% of your money back just in 1 year. So it looks like the revenue kind of slowed down. Revenue only grew 5%. That's like the lowest growth rate on the screen. But still, I love the net income they're printing. Let's go to their website. Maybe we can figure out what it is they do a little bit better. Approve more loans and retain more customers with Pagaya Network. all with no additional credit risk. You can partner with us. So I guess here's their partners and stuff right here. Hey, cool. I guess they help out banks and stuff. Do they show like hey, look, they're partnering with SoFi. There was SoFi right there. So I guess SoFi pays them money or something. Cool. Headquartered in New York. Yeah, that valuation was just really cheap. So, oh yeah, Eric said RBRK. This is it's mainly like a hospital cybersecurity company, or hospitals are a big customer of them. Is there any news? No. But yeah, I love the growth in this company. The organic revenue growth is phenomenal. There's no earnings analysis. That's all right. But check this out right here. If we just go to revenue, this is what you want to see. If you're going to diamond hand a growth stock with no dividend that loses money, you want to see this sort of organic revenue growth. Like the growth rate at the bottom, revenue is up 46%. Last year grew 48, 51, 48, 47. So that's phenomenal growth. It's either growing 40 or 50% every quarter. They are still losing money, but notice they're narrowing their losses. Like they used to lose a lot more. And check out what the analysts projected. They projected them to lose 99 million. Well, they only lost 86 million. So they lost less net income than expected and made more revenue than expected. So that's why I like this one, and a lot of cybersecurity stocks that's like my favorite software sector out of all the software like sectors to buy. Like you could buy Adobe or Duolingo or Salesforce. I really like the cybersecurity industry specifically, like a Rubrik, a CrowdStrike, a Palo Alto Networks, and a lot of them are doing really well. So Marvel right here, yes. Thanks again, Brian. Let's see, weekly news. AMD discloses an $11 million stake in Marvel. So wow, did anyone know that? So AMD actually owns some Marvel shares. That's pretty cool. And Marvel recently acquired Polaritron Technologies to enhance its silicon photonics capabilities and announced a strategic partnership with NVIDIA, which invested $2 billion into the company. Oh, so yeah, NVIDIA bought $2 billion of this company's stock. I forgot about that. Okay. That's why they're at an all-time high. Well, basically every chip stock's at an all-time high, like AMD, NVIDIA, all of them. So Dave said, what site are you using? Hey, I'm actually on a brokerage. Brokerage I'm on, it's actually linked in my bio, brokerage called Moomoo. But check out the future projections for Marvel. This is what you want to see. Revenue is going to go from 2 billion to 2.58 billion. And in net income, they're going to make 390 million. So this is the most impressive part. They're the most profitable they've ever been. Look, a year ago, it was a tough buy, really choppy, losing net income every quarter. But now they're making like 300 to 400 million. And at this growth rate, especially with the AI shortage, what's it going to be the same time next year? I'm very curious. So that's why I like Marvel a lot. But it's kind of, it is expensive. At an 87 forward PE, you can't really buy the stock now at all-time highs. But yeah. They're saying that second line here, net income reached 2.7 billion, driven by AI data center demand. Cool. The company divested its automotive Ethernet business. Yeah, so if you're wondering, here's why we're not looking at net income. Last quarter, it says they made 1.9 billion in net income after tax. When before tax, they made 367 mil. How was that possible? Well, they sold out of that Ethernet company, and that's where they got the proceeds from. In cash from investing activities, if this number is positive, that means they actively sold out of one of their assets for a profit and received cash for it, and that's why this was positive. They sold that asset for 2.4 billion. And all the other quarters, it's always negative. You usually want that to be negative because that means they're buying new assets and investing in the future. So, oh yeah, MXL. Let's do MXL and then that one, dude. Good to see you, man. Then we'll do Zscaler in Japan. Good to see you. So Max Linear stock right here. They've had a phenomenal rally. Check that out. Congrats if you own this one. You definitely got to be up on your position. I'm assuming it's just momentum from the space industry. Is there any news around this company either? No, there's no news. Are there any like intelligent comments here? I don't know. So let's see what they do. So they're the communication of system on chip solutions. Oh, wow. They actually are growing quite nicely. Revenue's up 43% year over year. So yeah, revenue's up 43. Is that a record? Well, it's down bad from their 2022 level, but at least it is growing again. Are they profitable on that? So that's the one scary part. They're still not making any money, losing like 40 million of net income a quarter. But that's no big deal. Well, it actually is a big deal because there is no forward PE. Or the forward PE is at 1,300. Yeah, then 8.4 billion market cap, it's tough. Let's see right here. Okay, look at the third line here. Optical data center business outlook was raised significantly. So that's probably the context I'm missing there. They rose their guidance. That's what sent the stock up. So, despite like okay earnings, it must have been future guidance. I don't know though. So I apologize. Can we look at low cap stocks even if they're bad? Sure, yeah. ALOY stock. ALOY. Real oil. Okay, yeah, you definitely want to be careful with these. And then we'll look at Team and Zscaler and RDW. So if you look at the top right, you're right. This one is really tiny. They're only worth $516 million. So that is a small company, $516 million, but let's judge them off the financials and see if there's maybe something of value here. So they're revenue-less. Okay, so they're kind of a startup. They have no, we click on revenue, it says no data because they've never sold anything. So what do? They're headquartered in Florida. It's in the supply chain of rare earth elements and magnets. So that they maybe own like a rare earth mineral mine, but it's not, and it's not making anything yet. So yeah, I wish I could wish I could give you thoughts on this company, but look, there is no net income or revenue or for me to even judge it. So I would be careful with that one. Sorry. So TEAM stock. So Atlassian, this is a software name. Wow, they have not done too well. The stock is technically the same price as they were back in 2018. So the stock has been flat for a while. Let's see, did they just report earnings? So cloud business revenue increased 26%, driven by over 53,000 customers, generating more than 10,000 in cloud annual reoccurring revenue. So 53,000 people paying over 10K a year. AI, so that grew 26% year over year. Their AI integration expanded with monthly active AI users growing 50% quarter over quarter to 3.5 million. So cool. Let's go see what their revenue growth is. So their revenue is 31%. That's great. That's a record revenue. So like that's what you want to see. The revenue just literally hits a new record every single quarter. So revenue is 1.7. And they are still losing money. So that is the one bad part. That might be why the stock is struggling. Software companies that are losing money aren't being really rewarded right now. So yeah, they are still losing a lot of money, like 100 million this quarter. Was that real though? Well, they lost 56 million. Yeah, so they really are losing like 50 mil a quarter. It's tough. But I like the revenue growth in the cloud business. But so actually, Morningstar says they're undervalued. The strong adoption of its cloud solutions, a highly sticky user ecosystem, and the effective monetization of new AI capabilities will continue to drive long-term value growth. There you go. It's just the net income you want to be careful of. So next up, oh yeah, Zscaler. This might be a similar company. We just looked at Team stock, and then there's Zscaler as well. This one as well hasn't done too well. Hey, yeah, we'll do Uber after this, or it's their Labs and Uber. And so Zscaler, how's this one doing? Morningstar says they're undervalued, secular tailwinds of zero trust security, rapid scaling of AI security products. So is this like a cybersecurity company? Huh. Maybe it is. Let's check out their earnings recap. So cloud service revenue is projected to grow robustly, supported by AI. Billings are expected to rise. Operational efficiencies. Okay, so that's all good. This is another one where the revenue just hits a record every quarter. Like that gets so impressive. These software companies that literally quarter by quarter, the revenue hits a new record. So yeah, revenue's up 26% after grew 23. But it's another one where I think they're just being hurt because they're not making any money yet. Like we really want to see these companies finally make some profits because all they've done since they've IPO'd is just lose money every quarter. But luckily they're not losing that much. But it does look like the losses kind of just worsened this quarter to 34 million. So anyway, we just want to focus on profits there. Okay. Can I download that Moomoo app for free or do I have to make an account? Yeah, you have to make an account, but it is free. Yeah, if you'd like to get this app and this brokerage, it's where you analyze stocks and buy stocks on it. So I have an affiliate link linked in bio, but you don't even have to deposit money. You can still analyze stocks completely for free without depositing anything. But if you do deposit money, we'll both get like $100 or we'll both get like a little bit of free stock. I don't know why I said $100. I wish I got $100. But anyway, here's Redwire right here. Redwire provides technology for NASA's Artemis 2 mission through Lockheed Martin contract. Oh, cool. So yeah, this Artemis 2 mission, the SpaceX IPO, has sent a lot of these space companies, like the momentum has been really good. So defense tech segment surged, or revenue surged 34 million, driven by the Edge Autonomy acquisition. So it looks like they just acquired Edge Autonomy. That's cool. Record contracted backlog reached 498 million. Wow. So they have a $500 million backlog. That's pretty cool. So Let's go to their yeah, so they did buy a company for 156 million that one quarter. Huh. So they are still losing net income every quarter, which sucks, but the revenue grew 56% year over year. The stock is still actually technically the stock is still like where they were in the 2021 IPO price, probably because of the net income losses. Like that's the I just don't like buying companies that lose a lot of money. It's justified though as long as they can grow their revenue super super fast and there's a clear path to profitability soon. Um, but hey, I do like what's cool about this one is they have a big backlog. They're providing technology for the mission, the Armidas 2 mission. They're actually diluting shareholders by issuing shares, getting cash, and then buying companies with them, which I do think is smart. But I'd keep the allocation that one low. Did you do LEU? Hey, Plasma, I have not done LEU. Let me do Uber, and then we'll do LEU stock. Uber is one of my most recent purchases. Oh, I forgot to do Astera Labs. Yo, LKE, if you're still in here, I'll do Astera Labs. So here's my, hopefully this doesn't show my password, but here's my Webull portfolio. Here's our open profit and loss. We're only up 20% all time, but here are all my most recent purchases in their exact order. So I just bought Ouster, Uber, Microsoft, AppLovin. So yeah, my second most recent buy was Uber. I bought them just like basically a month ago exactly. So what I like about Uber is they're cheap, just simple net income multiple. They traded 20 times next year's net income. I mean, that's just so cheap. Is there any specific news around Uber? They're like Uber announces 10 billion commitment to autonomous vehicle expansion. Yeah, this is like the picks and shovels of the autonomous vehicle like expansion happening right now because it's the platform you go to. It's wherever you go to book a autonomous vehicle on. That's where you collect the money. Uber drivers in Canada ratify first union contract. Oh. Well, anyway, check this out. They have literally 199 million monthly active consumers, up from 170 million year over year. So not just monthly active users, but monthly active consumers are at 199 million, up from 170. They're in mobility, which is ride sharing, and delivery revenue, which is actually, this is their growthiest business. Look at their delivery revenue. The growth rate at the top, it grew 34%. After grew 21, after grew 7. So that's the highest growth rate on the entire screen, 5 billion in revenue. So Uber Eats and B2B business delivery is actually growing super fast for them right now. And yeah, like if we just zoom out, this is what you want to see, record Q1 revenue, and also not just record Q1 revenue, but record profits from any quarter ever. Because like last quarter, they made more revenue than this quarter. Like 2025 Q4, they made 14 billion in revenue versus 13 this quarter, but they actually made more net income this quarter than last quarter. So which means margins are growing. So yeah, this is the most profitable quarter they've ever had. If like that's what you want to see, that's what justifies the 20x forward PE. That's why I think it's cheap because of how growthy they are. And yeah, here's where the revenue comes from. US, UK, Asia, so nicely diversified internationally. It's like the picks and shovels play. They don't own any actual vehicles, but every time you go and book an autonomous vehicle or a ride, they just collect a high margin fee. Uber executive criticized Waymo's autonomous vehicle expansion. Questions reliability of AV only approach. Anyway, yeah, there is some competition fears from like Waymo, which is owned by Google, but Google now has their Waymos on Uber in some areas. So, oh yeah, ALAB, my bad, I've missed that one. Let me do Astera Labs, then we'll get to, hey, what's up, Best Self Improvement? Good to see you, man. Thinking of buying 4K worth of MasterCard stock. Is that a good decision? I would think so, or I'd be more, maybe dollar cost average into it more, but I love MasterCard and their current valuation. That is a stock I want to go over soon. We're going to be live for another like hour, so I apologize if I'm missing some stocks here. I want to get to all these. Mind showing your portfolio? Oh yeah, hey, I do portfolio updates all the time on my YouTube channel. You can see every stock that I own. I got way too many stocks for me to quickly just like glance at. But yeah, these are my most recent purchases in there, and I also have my Robinhood portfolio, my Roth IRAs, but I definitely own way too many stocks. But anyway, check out my most recent YouTube video. My YouTube channel is called Nathan Robert. If you just type into YouTube Nathan Robert, I'm also streaming on there too. You can see my whole entire stock portfolio. I'm fully transparent. I don't hide anything. I show my lifetime profit and loss on all my portfolios and all the stocks. So anyway, here's Astera Labs. This is one of my favorite AI infrastructure growth companies. I promise the financials will impress you. Like, it's so impressive how growthy this company is. So if we just go to revenue right here, basic revenue metric, it's a crazy record. 308 million, it's up 93, after grew 144. That's unprecedented growth. So not only record revenue at 308 million, but like record net income as well. They made 80 million of net income on that, up from 31 million the same time last year. So the net income grew 152 when the revenue grew 93. So what does that mean? That means margin expansion. Net margins are up 30% year over year. And a huge cherry on top, a huge safety net is the fact that they have no debt. This is a debt-free company, literally with 1.18 bill of cash, and that cash is also earning them interest. So they literally made 11.5 million of just interest on their cash. So I have nothing to complain about here. Yeah, they print free cash flow. Look at these year-over-year growth on the free cash flow, the revenue, the net income. It's just pure growth, and I love it. And the fact that they have no debt, Fortress balance sheet makes me happy. What YouTube? Yeah, my YouTube channel is called Nathan Robert. Hey, I appreciate you. Yeah, hey, thanks for going over to the YouTube stream. I'm actually about to end the TikTok stream and just only exclusively stream on YouTube after this, because TikTok removed my For You page eligibility, and now the TikTok stream is just cooked. But anyway, yeah, YouTube channel is called Nathan Robert. If you just type that in, you'll find it. Same as my TikTok. So next up, let's see. Yeah, Astera Labs is crazy good. I love that stock. So Jay said, oh wait, CCJ, is that Cameco? I thought that was Cardinal. I thought it said CCL for a second. Yeah, this is a uranium company. If you want exposure to uranium, this is by far like the best uranium stock. Unfortunately, they've just done so well that it makes it like impossible to buy at such an expensive valuation. But out of all the uranium stocks, this is literally the most quality one. They make the most consistent net income. LEU is good as well. LEU is another good uranium company. But yeah, that's most of this company's revenue. Let me actually go to the earnings hub here. So the uranium segment, it's a Canadian company, generated $711 million in revenue, driven by increased sales volume and improved average realized prices. So that's great. So the US and Canada, we're no longer buying our uranium from Russia. We're trying to be more rare earth mineral independent. So these Canadian and American uranium mining companies have been doing phenomenal, just like Cameco. And as we know, uranium is what fuels nuclear reactors. You know, that yellow cake uranium, and nuclear plants are like, there's been so much favorable regulation toward nuclear. So Best Self said, he said, what was it? CMPS. Let's check out CMPS. Then we'll go to, hey, what's up, AJ and Christian? I'm so behind. I apologize. And what's up, Michael? And Spray Cheese. What's up? We'll look at USIO after this too. So here's Compass Pathways. I have not heard of this company, I don't think, but they're doing pretty well. I mean, they just had a massive gap up, and that wasn't on earnings either. So that wasn't on earnings day. So I wonder why they gapped up. What do they do though? So they don't have any revenue. That's the weird part. Is this like a blank check company? So we go to revenue. It says 0 because they have no sales. So yeah, we go to revenue. It says no data because they've never sold anything. Medical care facilities. It's a biotech company which provides mental health services. It improves lives of those who are suffering with mental illnesses. Okay, but how? Is there like they own like psilocybin therapy? Okay, so I don't know how I don't know if they're mushrooms fixing. Anyway, I don't know much about the company, but let's go check out the financials because I would be curious to see. Oh yeah, wait, there is no financials. There's no revenue. It's a revenue-less startup. So I wish I could give you real thoughts, but there is no revenue for me to judge. And they lose 40 to 50 mil a quarter. Ooh, so I actually would not buy that company. That's the one scary part. And there might be regulation toward that industry. I don't know. Maybe it's like a leaf sector kind of thing, but yeah. So, oh yeah, I forgot to get to Alibaba. There's so many stocks I haven't gotten to that I've been needing to. Hey, what's up? We'll get to STM and TTE. So here's Alibaba. This is your Chinese Amazon, and it's more of like a business to business more than like a business to customer like Amazon is, because this is like a drop shipping company. A lot of US companies buy stuff in bulk from Alibaba or AliExpress. So, oh yeah, they have a crazy cloud business. Well, actually, I wanted to go back to that. So cloud revenue grew 40% year over year, achieving triple-digit growth for the 11th consecutive quarter, now 30% of cloud revenue. Core commerce showed stability. Customer managed up 8%. Quick commerce revenue surged 57%. Well, anyway, let's go see what the valuation is. So they trade at 23 times net income. So yeah, they own AliExpress, but check out this cloud business right here. It's like a Chinese cloud company. like Chinese AWS, this is up 42% year over year. So that's very growthy, 42% year over year. And again, this is in US dollars. We've converted it from Chinese to US dollars. So yeah, they really do make like 2 to 3 billion in net income a quarter in US dollars. Any other specific news here? Alibaba AI model projected 8 billion in ARR, but that's some weird currency. Alibaba commits to continued AI and cloud investment, expects margin improvement from model as a service growth. Well, anyway, there you go. US approves NVIDIA H200 chip sales to Alibaba and 900 Chinese firms. So, hey, they're buying NVIDIA chips. There you go. Oh, waiting to get FDA approved. That's what that was. Okay. For that other stock. So, USIO, well, I've not heard of this stock before. So I would be very careful. Yeah, if you look at the top right, they're only worth $41 million. So it's kind of just a tough market cap to trust. You know what I mean? Only worth $42 million. I don't know if you want to put your hard-earned money into this company, but what did you do? Merchant service and output solutions. Huh. What's the revenue? So the revenue grew 15 to 25 million, which technically was the highest ever revenue. So record revenue this quarter, but what were the profits? So, okay. They're kind of choppy. I mean, they did make money this quarter, but then they lost $1 million. But luckily, they're barely losing any money. The quarters they do lose money, it's only 300K, 400K, so that's good. Not a great balance sheet. That's a lot of liabilities to pay. Only 7 million of cash left. What's the debt? Didn't they have like 100 bill of debt? Where's the long-term nasty stuff? Or only 1 mil of long-term debt. Well, where's the current debt? Oh, well, I don't want to deep dive into them, but anyway. Maybe it's the leverage. I would just be careful with this one. It's good to see that the revenue is at the highest ever, and they're barely losing any money. What do they actually do though? Maybe we can go to their website real quick. Or integrated payment provider, or payment solutions provider, like a Toast or something. I don't know. It's a PTP payment service. Oh, okay. Card-based processing, electronic billing products. Cool. Anyway. I know that they kind of do what Toast does. Okay, ServiceNow when you can, please. Here, yeah, let's do ServiceNow. Then we'll do Poet. Someone said, hi, I just bought Poet. Was that a mistake? We'll check out Poet. I really like your portfolio. You should do an ETF. Hey, what ETF you want me to look at? We can check it out. So here's ServiceNow. This is one of the main software stocks falling, because of AI. But the cool part is they just gave 2030 guidance of $30 billion. So for the full year 2030, they're going to do 30 billion of revenue. If we go to full year 2025, they did 13 billion of revenue. So it's supposed to grow from 13 to 30 billion of revenue. So that's the good news. That's why they're so expensive. So here's the bad news. Even though they're on this massive downtrend, they're still expensive on a PE ratio. If we go to a price to, or even next year's net income, they're trading at 43 times next year's net income, which is still expensive. That's the only bad part. I feel like it could still maybe fall. If software goes through another down phase, this could fall to like a 38 or a 35 forward PE before it bottoms. So that being said, it's a good quality stock with good growth that's already super net income positive. They're already making a couple $100 million a quarter, but it's not the time to go all in yet. Like if you wanted this at 5% of your portfolio, don't make it 5% today, but maybe go ahead and make it like 0.5% or 1%. So yeah, I just have a little fear that the forward PE could still fall down a little bit, but that's it. I should have pulled up the revenue growth. Yeah, if we go back to ServiceNow, super quickly, just this revenue growth, this is what justifies, the high multiple. And again, they just gave 2030 guidance. It's not done here. It's not done now. But every quarter, it's like, I can't even find 2 quarters where it like stalls. Literally every quarter, the revenue hits a crazy new record. Isn't that ridiculous? And here's their net income as well. They're also like the most profitable they've ever been. So anyway, that's why I like ServiceNow. Out of all the software stocks that buy on a dip, they're definitely the most quality. Fine, I'll invest in Constellation Energy. Oh, hey, not financial advice. I'd definitely be careful with that one. But yeah, that's my favorite utility company. So POET, this is like a photonics play. They got all their, wow, they fell. I remember this day. They fell like 70% this day because they canceled their order. Someone canceled an order over a confidentiality breach. Yeah, so look at this. Poet, it's like the very bottom here. Poet Technology discloses Celestial AI cancels all purchase orders due to alleged confidentiality related disclosures. So that's why they fell so much on that day. But they've just been up ever since. And I don't know if it's like, I don't know. Okay. So Poet secures 50 million order from Lumiles, potential 500 million 5-year partnership for AI optical infrastructure. Poet raises 400 million by issuing shares. Well, there you go. Wait, what did that say? Discloses a 10% stake. Okay. Wait, what was that last line? Poet Technology CFO to retire after 10 years of service. Okay, well, that's no big deal. Yeah, here's the tough part. If we go to right now's revenue, it's like nothing. Literally 300,000 of revenue a quarter. It's just such little revenue. But look at the forecast. It's supposed to grow to 2.4 million in 2 quarters, which still is nothing. So 2.4 million. But basically the point being, what I'm trying to say is you're buying this company as they're converting from a revenue-less startup to finally having revenue. But it's tough. I don't know if it's a mistake. I would just keep this one as a super small position because again they lose dang 40 mil, 10 mil, 17 mil. They're losing a lot of net income, and they're only doing 2 mil of revenue in 2 quarters. So you might want to see hopefully they beat on those numbers. If they beat on those numbers, yeah. Marvel canceled the orders. Yeah, dang them too. So appreciate the review on USOI. Yeah, no problem. Cheese. If you got another stock, let me know. So Norbero, thank you for your service. Hey, thanks, Mr. Dallas. I appreciate you. Just bought ServiceNow. Oh, hey, nice. KLAR, this is your buy now, pay later company, Klarna, kind of like an Affirm. Oh, hey, I see Peloton. I guess we could do Peloton and Duolingo, CSU. Is that Constellation Software? We can check them out too. So here's Klarna right here. They just that's another tough part. Since they just IPO'd, we don't have too much data to really analyze. Like, look, that's all we can zoom out. I can't zoom out anymore. This is all the data we get. But notice, revenue grew 44% year over year. That's great growth rate to $1 billion of revenue for the first time ever. So $1 billion of revenue, and they made money on that actually. Check that out. They made $188 million before tax, and after tax, they only made $1 million. So I'm assuming they had some one-time adjustment. But anyway, that's your buy now, pay later stock. Can we get like AI overview? Dang, no, we're not going to get that. But here, let's go to their website, investorsklarna.com. Go straight to their investor relations page, not their website. Interested in Klarna, hear from our co-founder. Okay. Maybe they don't do, oh yeah, pretty sure it's like a buy now, pay later stock. Do they have like an investor presentation? I don't know. Oh, here, investor presentation. Yes, dude, I love looking at these. So active consumers, 119 mil. Anyway, you probably, if you're a real shareholder or if you're really considering shares, you probably want to go deep dive into these, like the delinquency rates, because they're saying, oh, here's their guidance right here. So they're going to do basically a bill of revenue next quarter, 50 mil of operating income. Anyway, another buy now, pay later stock would be like an Affirm, AFRM. This is probably the best buy now, pay later stock out there. They just got net income positive. They're both, that Klarna just now got net income positive. But yeah, check out this one. They're now making like 100 mil in net income a quarter. Pretty impressive. But in a recession, these buy now, pay later loans, we suspect just won't get paid back. And these buy now, pay later stocks just get smoked in a recession. So Peloton, what is that ticker symbol? Is it PTON? Yeah, Peloton Interactive. You know, they sell like the workout machines, the weights and stuff. So they just like rose their subscription prices and they had a bunch of churn from it. So people like canceled or but the actual revenue's growing, but actual subscriber number went down because of that. But yeah, look at that. Subscription revenue grew actually 2.27% year over year. So that's good. 26 million net profit. Oh, really? They're finally net income positive. Wait, did that say 2027? 20 analysts revised their 2027 forecasting projection of EPS of 27 cents, reducing from 28 cents. So I guess they lowered guidance. Oh, well. Yeah. The good news is they really are supposed to stay net income positive if the analysts are right. Next quarter, they're supposed to make 60 million and then 48 million. So what's the forward multiple then? That actually has to be a cheap forward PE if I had to guess. Yeah, I mean, a 15 forward PE or 15 times next year's net income. If they stay that net income positive. Yeah, look at this. So they are leveraged, more liabilities than assets. This was your huge COVID play. Right when COVID happened, everyone was staying at home working out. This stock was, I remember, it was crazy huge. is one of the like beneficiaries of COVID, but then it's like reality set in. Uh, anyway, I think they're even, yeah, they had a little partnership with Spotify. Just be careful with that one, but I do like that the net income forecasts are good. Check Donkey stocks. Hey, you got a ticker symbol for me, or what is that stock? Let me do okay. Duolingo. Then we'll do HQ. And any thoughts on PSIX? Oh yeah, PSIX. I do own that company right there. And I'm down. Actually, I think they recovered, but I'm still down on the position. So here's Duolingo right here. If you're wondering what is Duolingo, it's an app you go on to learn a new language. So you basically pay this company every month to learn a new language. But the bad news is they're saying in 10 years from now, kind of think about this, in 10 years from now, will we need to learn new languages? Will the live AI language translation technology be so good that we just don't need to learn a new language, or unless it's not mandatory for a class, like it will just be so good. But anyway, that's kind of the fears around Duolingo. And here's the other super tough thing. I'm not kidding when I say this. Even though they're on this massive dip, like look at this, they went from 540 to 110. Even on this massive dip, they're still expensive on a PE ratio basis. And that's the tough part. They are trading at 37 times next year's net income, which makes this company not exactly cheap, even on this huge dip. That's the one scary part. And if you're like, well, they're at a 12 PE. That's actually a one-time adjustment. They're not actually at a 12 PE. Look at this. You see this Q3, it says they made 292 million of after-tax net income. They only made 35 million. This is the before-tax number. They just had a one-time adjustment, gap adjustment. So that's why, so it artificially made their net income look higher, which makes their PE ratio look really low, but you really value them off next year's net income. And unfortunately, a 37 forward PE makes this one a tough buy. So yeah, is there any specific, but here's the thing, they have great subscription revenue growth. Like if you go to their subscriber growth right here, like all this AI fear isn't hurting them yet. This subscription revenue's up 32, after grew 45, after grew 50, after grew 56, after grew 53. So it's on a nice streak of growth. Their growth rate is kind of slowing down a little bit, but still, I'm really impressed. Hey, J Crump, thanks for the gifts there. I appreciate that. If you got a stock you may look at, let me know. We'll definitely check it out. So what was this one? PSIX, this is a stock I own. I haven't done actually too much research on their earnings, but dang, yeah, I'm down 41% on my position. So RIP, yeah, there's my 5 shares. It's one you never really wanted to own as a meaningful size position. I've kind of always covered that. You want this one as a small size position, but here's why I like this one. It's a small cap. If you look in the top right, they're only worth $890 million. So out of all the companies worth $890 million, I want to buy the company that actually makes net income every quarter. The bad news is the net income is declining now. Is that real though? So yeah, the profits really did fall 50% year over year. So revenue fell, okay, so yeah, that's bad. Revenue fell 5 and the profits fell 50. So that is understandably why the stock fell so much on earnings. But it might not be fully priced in because check out this forward PE, or well, a 15 forward PE. Maybe that could still go a little lower. I don't know. That's the tough part. But anyway, yeah, that's why the stock did bad this quarter, because of the revenue and net income miss. Yeah, what did the analysts project? Yeah, analysts projected 16 mil. They only did 7 mil. And they missed on revenue. Analysts expected 160. They did 130. So it now starts to make sense why they fell. So yeah, RP, my position, I'm down 40%. You can't win them all though. That's why you got to have a diversified portfolio of a bunch of stocks you think will do well. Here are my other big losers like UiPath, Sprouts Farmers, Zoom, Progressive. We're down bad on those too. So next up, what is SES AI? Yeah, hey, Ghost, please give me the ticker symbol and we'll check it out. So now we'll check out, what's up, Pontus? He says HQ. Horizon Quantum Holdings. I've not heard of this company before. Looks like they just IPO'd, so we're not going to get too much data to analyze, unfortunately. Yeah, so we go to revenue right here. We only get 1/4 of revenue, and it was only 30,000 of revenue. That is tough. So they did 30,000 of revenue, and they lost 3 million. They didn't lose that much money, but yeah, there's no revenue forecast here. So they're actually headquartered in Singapore. So this is a Chinese company headquartered in Singapore, and this is their whole company description. Engages in the development of software tools. Company's headquartered in Singapore. They have 44 employees. Yeah, it's just hard to really trust this one. You know what I mean? There's no analyst covering this one, so I can't really see what the forecasts are. There's only 1/4 of data, and the data is 30K of revenue. So I would be careful with that one. Hopefully that kind of makes sense. Hey, G Crumb, thanks again for the gifts there, dude, for the boxing gloves and the Coke, dude. Thanks, man. He says RDZN. Oh, yeah, then we'll do OOMA. I didn't know that was a stock. Yeah, we'll do OOMA after this, too. And Redwire and STM, Planet. We'll look at all these. So here's Roadzen. Huh. I have not heard of this stock before. They're worth 149 million. So you do want to be careful of that market cap just because when companies are worth so little, it's just hard to trust a lot of money in these. Income from insurance as a service. Oh, interesting. So they're maybe like a direct-to-consumer insurance company. Commission and distribution income. Well, let's go to their website. Maybe we can, Roadzen AI. Huh. Is building the next generation of auto insurance. Okay, the end of insurance for every driver on the road. So there you go. Some sort of auto insurance. They got 300 employees, 8 offices. Trusted by a lot of other companies. Okay, cool. Well, the revenue's still a little tiny. You know, combined, the revenue was 14 million. And they are kind of leveraged, more liabilities than assets. But yeah, dang, they're not net income positive yet. So that's a tough thing. Like they lost basically 10 million this quarter. That's not a lot of money, but when your whole entire company is only worth 149 million, losing $10 million is like 7% of the company. So we really want to see this company get net income positive and narrow the losses. And that one could be cool. Reminds you like a Lemonade. LMND. This is another kind of insurance company that's not profitable yet, but they're growing nicely. Like if you go to revenue right here, dang, revenue is super growth. It grew 70% this quarter. That's cool. But anyway, let's see. Next up, oh yeah, RDW, is that Redwire? Yeah, this is your drone manufacturing company, and this was one of the NASA beneficiaries. Yeah, check this out. The first line here. Redwire provides technology for NASA's Artemis 2 mission launch through a Lockheed Martin contract. And check out the second line. It says they have a record backlog of 498 million. So they have a $498 million backlog. A lot of the growth this quarter did come from an acquisition. So if you read the first line here, defense tech segment surged with 36 million of the revenue from this Edge Autonomous acquisition. So the total revenue this quarter was 96 million, and 36 million of that was because of their Edge acquisition that they did. So anyway, it's still one I would not own this one really meaningfully because it is still really risky. Losing a lot of net income every quarter, well over 50 million in net income a quarter they're losing, but they have a decent balance sheet and they have a backlog. They're doing acquisitions. So yeah, they're diluting you as a shareholder and then buying acquisitions or doing acquisitions. It's kind of smart. Next up, oh yeah, OOMA. I've not heard of this one, so let's check it out. UMA stock. Huh. They're the same price as they were in the year 2020, but they've had a nice little recovery. Let's see what industry they're in. I am curious. So subscription and service revenue. That's nice. I like subscription model companies. It's all reoccurring. It's predictable. And that actually grew 13% year over year. That's technically the highest growth rate on the screen. Because check out all the other quarters before today. It was kind of single digit, like 3, 2, 3, 4. But now double digit 13, that's great news. So yeah, analysts expected 72, they did 75, and they're net income positive. So that's really impressive, and that's real as well. Like even operating profit, they really are net income positive now. So you're basically buying this company as they're finally going to consistently stay net income positive. That's great news. Did we get analyst projections? Yeah, they're supposed to make 2.5 mil next quarter, 2.6 mil next quarter. So subscription model company. I just don't know more about what they actually do. We don't know if they're like maybe exposed to AI. Maybe Anthropic has something that'll hurt this company. But anyway, a modern landline for kids, introducing My Phone, business phone, home phones, or maybe they sell phones, or I don't know what they're doing. Huh. Maybe they sell fired. I don't know. Cool. Anyway, there you go. There's UMA stock. Never heard of them before. So Christian said STM. Let's check it out. STM Microelectronics. Then we'll look at PLNT. Yeah. Sorry if it took me forever to get caught up. I'm a little behind on the chat. I apologize here. So yeah, here's STM Microelectronics. This company's at a pretty much all-time high. So congrats if you've ever bought this stock. You're definitely up on your money. Is there any news? No, there's no news around this company. So they report earnings on July 23rd. So we have a while. Morningstar says they're overvalued. While the company benefits from cyclical recovery and emerging opportunities in AI and low Earth orbit satellites, intensifying competition from Chinese chip makers in the electric vehicle market and highly vulnerability to global trade tariffs require caution. So, anyway, they're at an all-time high. So, maybe that's something to consider at all-time high. So they're in analog, micro, electromechanical systems, embedded processing or EMP, optical communications. How's the optical communications growing? That grew 33% year over year. So revenue combined grew 22. So the growth is like back. Well, the revenue isn't as high as it was in 2022, but the revenue did grow 22% year over year. Maybe it's just future guidance. I bet you they just had some future guidance. Maybe it's part of the shortage. Like, I don't know if they're part of the memory shortage or the CPU shortage or what. But let's see actually, yeah, that'd be important context. The future net income projections. Dang, yeah, look in 2 quarters. They're going to make $362 million in net income. If we zoom out, the net income, hasn't been like that high in a long time. Yeah, dang, that's crazy. In 2023, they were making over $1 billion in net income a quarter. Now it's like nothing, yet the stock is at the highest valuation it's ever been. So there's obviously some sort of future good news that's being priced into the stock, if I had to guess. PLNT chart looks good after the dip. Oh, Planet Fitness. Yeah, this is your gym subscription model company. So let's see how they did. I actually haven't looked at them on earnings. Technically, they're at their 2020 dip price right now. So yeah, let's go see if this decline was justified, because I don't think it was. So they traded 19 times net income and 17 times next year's net income. So they own the corporation, the stock owns a bunch of clubs themselves, owns some gyms themselves. That grew 7%. But the cool part is the franchise revenue, where whenever you go to a Planet Fitness franchise, they have to send a portion of their subscription revenue back to the parent company as a high margin fee. So yeah, this franchise revenue grew 10% year over year. That's what I love. So yeah, here's their net income down here. This is great. Technically, this was the highest ever Q1 net income. The net income was $51 million, up 25%. Revenue's up 21, net income's up 23. So their margins expanded too. Free cash flow was $122 million, highest ever free cash flow quarter ever. Yet the stock tanked. I don't know. I wonder if there's like specific news here. I don't know. But whether or not you go to the gym every month, they're collecting that high margin subscription revenue. Yeah, that's weird. They beat on net income. Analysts projected 41. They did 51. And they expected 298. They did 337. So then I don't know why they fell. Must be something I'm missing there. That is weird. Hey, what's up, MC? Dude, thanks for that gift. I appreciate you. Just curious, how do you tell when a one-time adjustment happens? Yeah, so you compare the operating profit with the net income. Like Duolingo is a great example. Tesla does this all the time. But anyway, the operating profit, this is the before tax, before interest number, and before one-time adjustment number. So look at Q3. They made $35 million before tax. How did after tax then did they make $292 million? Well, it was a one-time adjustment. This could be things from like a realized gain, that's what it usually is, like a realized gain on some sort of asset that they sold. So, and realized money from it. But yeah, that wasn't the core business making them that money. So that's why I like to always compare the operating profit with the net income to see if this company is having some one-time adjustment affecting their numbers. So yeah. And we can kind of see that from the analyst projections. Like 2 quarters ago, analysts expected 76. They did 595. And you can see on EBITDA as well. It's not included in the EBITDA as well. So like net income in Q3 was $290 million. But the EBIT, basic metric to understand, it's the earnings before the interest and taxes, was 35 mil. So starts to make sense. Anyway, hopefully that was kind of helpful there. Drink some water. You've been live for yeah, dang, we've been live for an hour 55 minutes. Yeah, I try and stream for around 2 hours, like every Sunday. Yeah, if y'all want to hit the follow button, I stream every Sunday this exact same time. I sell nothing. I have no course book. Just wanted to give my opinion, analyzing y'all stocks. Can you do Nvidia? Yeah, let's do Nvidia. NVDA. I feel bad because oh no way. Hey, Tangrika, thanks for that gift there. I really appreciate that. I was about to end the TikTok stream and just continue the stream on YouTube, but hey, thanks for that. I appreciate that. So Nvidia right here, this is what's crazy. Yeah, if you got a stock you may look at, definitely let me know. We'll check it out. And what's up, Ramen? So yeah, Nvidia, here's the crazy part. They just got allowed to sell a bunch of chips to China. Nvidia expected to report 79% revenue growth. When did they report earnings? Let's Let's see. Nvidia agrees to invest 2.1 billion into Iris Energy. Okay. Nvidia commits 40 billion into AI investments, including 30 billion stake into OpenAI. So Nvidia owns a 30 billion stake into OpenAI. Um, Nvidia CEO warns AI computing may require 100x more energy as industry faces capacity constraints. Hey, that makes me bullish on CEG, Constellation Energy. But anyway, the real bullish news was, yeah, the US approves Nvidia's H200 export of chips to Chinese firms. So that's going to be a nice tailwind for the earnings. Check this out. Here's the crazy part. If we zoom out, Nvidia stock is at an all-time high. Even though Nvidia is at an all-time high right now, look at the forward multiple. They're only trading at 27 times next year's net income. That's still cheap. Like if you do a PEG ratio, price to earnings growth, Nvidia is still cheap, which is crazy. We've been saying that. 24% GPU market share. And here's the actual net income projections. They're going to make 42.5 billion next quarter, 46 billion the quarter after. That's going to be growing from 26 billion. So they really are going to grow like an absolute monster these next couple of quarters. Still going to have nearly 100% EPS growth. So that's why the PE ratio is falling so much to a 26. So they're kind of cheap. They're like the picks and shovels play, the ones selling the chips for the high margin. So MC, dude, thanks for the gift there. He said ServiceNow. Yeah, let's do ServiceNow. Then we'll do thoughts on Net and Solar SEDG. Yeah, we'll check those out too. So here's ServiceNow right here. Is there any specific news? ServiceNow and Experian for partnership? No. Out of all the software stocks to buy, this is one of the most quality software companies. But there's one thing that scares me, and that's the multiple. They're still a little pricey. And if software does start to fall again, I think this one can still fall. Because if you look on the right, they're still expensive, trading at 44 times next year's net income. So it's not like they're at some cheap forward PE. No, they're trading at 44 forward PE. I feel like this could still fall. If software stocks fall again from AI or whatever, this could fall to like a 38 or a 36 forward PE before it bottoms out. But they certainly deserve a high multiple. If you're wondering why is the PE ratio so high, it's because of the guidance. So full year 2025, they did 13 bill of revenue. They just guided themselves. This is a far year out kind of guidance, but 2030 guidance of 30 billion of revenue. So revenue is going to more than double through 2030, or like CAGR at like a 30% plus rate through the end of the decade. So that's what's impressive about them. And they're already super net income positive. Yeah, if we zoom out, look at this. This is why they're expensive. It's that good guidance and the fact that the revenue just hits a new record every single quarter. So yeah. The PE for ServiceNow on the other app is actually a 30. Not sure why it shows that there. Oh, really? That's interesting, MC. But yeah, check this out. The revenue just hits a new record every quarter. Let's actually go check out the other app's forward PE. So yeah, this brokerage, and this is from S&P Global Estimates. This is at a 43 forward PE. How many analysts are on that? So that's from 13 S&P Global analysts. Here are the actual numbers. They're supposed to make 330 mil next quarter, 580 mil, or here's the actual EPS numbers on that. Let's check out the ServiceNow forward multiple on Webull, which doesn't use S&P Global. They are at oh, wow, it's even more expensive. Look at this app. We got analysts all around, MC. Look at this one. The PE is a 50 on this app on the left there. If you can kind of see on the left, a 56 trailing 12 months and a 50 forward. So, how do you use the PE ratio? Yeah, so basically the PE trailing 12 months, that's the price to net income. So on the left, it says 56. So this company trades at 56 times net income. But for growth companies, you really want to value them off next year's net income. So you do a forward PE. And so this company trades at 43 times next year's net income. So anyway, hopefully that was some helpful context on ServiceNow. I still love the revenue growth and the net income growth. So thoughts on Cloudflare and SolarEdge? Yeah, let's do those too. And we'll do Toast and Lululemon. That's a cool one. So here's Cloudflare right here, a cybersecurity company. I love the cybersecurity industry specifically out of all the stocks. So Cloudflare cuts 1,100 jobs in AI-driven restructuring. CEO acknowledges company's name challenges. All right, so let's go. Yeah, the tough part is they were expected to get net income positive a while ago. But look at this. They're kind of still losing net income, lost 20 mil, 12 mil. So at least they're not losing that much money, but it's still not great when you lose, money every quarter. But the good news is they are a growth beast. It's another company like ServiceNow where every quarter the revenue hits a new record. 640 million just this quarter, up 33 after grew 26. Let's go get the earnings recap here. That would be cool. I want to see more on their subscription numbers. I wonder if we can find that out. Yeah, actually, this is cool data. I like when they do this because it's stuff you can't really normally see. Large customer segment grew 25% with 4,416 customers paying over 100,000 annually. Dang, so they got 4,400 people paying over 100K, which is 72% of all the revenue are these 4,400 people paying 100K or more. AI-driven demand is a key growth driver prompted by strategic restructuring to agentic AI first operation model with workforce reduction. Yeah, it's like that's a lot of people cutting 1,100 jobs. What's their total employed people? They only have 5,100 employees, so they're cutting 20% of the whole company's workforce. That should potentially, usually stocks rally on that news. Helps out their bottom line in the long run, but yeah, maybe it's just to help out their net income number. So pretty cool. That's Cloudflare, but yeah, there is no forward PE. The forward PE is negative, so they're not going to make any net income anytime soon. So, but yeah. Oh yeah, SEDG2 Solar Edge. Let's check out this one. Huh, weird. On Yahoo Finance and Interactive Brokerage, the forward PE is lower. Huh. Well, hey, that's why it's cool to always check out all the different. That's cool to see all the different analysts. So yeah, basically, you can just do your own forward PE. Just do like 600 mil of net income a quarter, translate that to EPS. Okay, so anyway, here's Solar Edge. They had a massive rally, up 23% on Friday, and there was no earnings, so that it wasn't because of earnings. So I don't know what actually caused that. Oh, here's some news. So Solar Edge reports Q1 revenue of 46% revenue growth and narrowed losses. Okay, that's great news because here's the tough part. Why this stock is down so bad from its peak, like if we go to the weekly chart here, it used to be a $300 stock and now it's a $60 stock. That's because the net income problems. Look at this right here. Like if we zoom out, 2022, it was great. They were making 20, 30 mil a quarter, but now check out since 2024. All they've done every quarter since 2024 is like lose 50 to 100 million in net income a quarter. And when you lose 100 million a quarter, which is 400 mil a year annualized, and you're not even worth 4 billion, you're losing over 10% of your entire market cap a year in net income. Whoa, look at the short interest go down. Maybe shorts are being squeezed. Dang, 40% of all the shares were being shorted a year ago. I've never seen a number so high before. 40%, but now it's fallen to 16, which is still extremely high for your average stock of 16%. Like my stocks are like 2%, but this one, that's crazy. Anyway, maybe there's a short squeeze happening. I'd still be super, super careful with that one, but maybe the momentum will continue. So let's do Lululemon, or let me do Toast and then Lululemon. Yeah, these are cool ones. So here's Toast. This is your restaurant like payment POS. What's that called? Like point of sale system thing. Anyway, handles all your billings and stuff like that. And they own the device where you like food trucks and restaurants, little device you tap your card on and it asks for a tip and stuff, like a 50% tip. They own that. And then they collect a fee off every time there's a transaction. So what's cool about Toast is they're pretty inexpensive, but they're inexpensive because they're in the restaurant industry. So a bunch of restaurants use them, and restaurants are struggling right now hard. If you look at any restaurant stock like Wendy's, Cracker Barrel, whatever, Jack in the Box, Red Robin, Krispy Kreme, they're all at multi-decade lows right now. But Toast, they're trading at 23 forward PE. I actually like this one. Out of all the restaurant stocks, like this is the most in the safest position because no one's going to cancel their payment provider, So the net income was great. They expected 95 mil. They did 126 mil in net income. So they crushed net income projections. So they're the most profitable they've ever been. If we zoom out, 126 mil in net income, that's a record. It's never even been close because it used to be a tough buy. They were losing money every quarter, but now they're making money every quarter. So pretty cool. And a pretty good balance sheet as well. Oh, and good free cash flow. So the free cash flow is 100 to 200 a quarter. The net income's now well over 100 mil a quarter. So yeah, only a 23 forward PE seems very fair. I wish I could click their website, but their website is like broken for some reason. Yeah. So consumer payment, it offers terminals, kiosk, guest-facing displays, system accessories. So point of sale, reporting and analytics, online ordering and delivery, kitchen display system. So helping out restaurants. So yeah. And like I said, yeah, like if we just go to Wendy's stock or any restaurant, a lot of them are struggling. So it's like their core customers, I think, that are struggling. How do you analyze if that's a good stock to buy? Well, there's a lot of metrics I look at to kind of blend together a bunch of metrics to determine if a stock's a good buy. So here's Lululemon right here. This is a apparel company, clothing, and these clothing stocks have really been struggling. And it's kind of like restaurants where it's not just like one clothing company; it's all of them. Like if you go to a Nike right here, Nike, yikes! Look at that multi-year low. Actually, Nike's lower than they were in what year was this? 2014. They've been flat for now like 12 years. Oh, y'all don't want to see Under Armour stock. Under Armour, same price as they were in 2006. So anyway, these apparel stocks are getting hurt bad. But Lululemon is probably one of the more better resilient ones. So yeah, as we speak, they're at like this new multi-year low. What's the valuation at this point? So they're trading at only 9 times net income, a 9.6 forward PE. That's reasonable for a clothing company. International expansion fueled revenue growth offsetting flat and declining North America sales. China mainland revenue is up 28%. Profitability was under pressure with gross margin falling 5.5% due to tariffs and markdowns. Okay, let's go see that margin decline they're talking about. We'll start with revenue. So year over year, the revenue only grew 0.8. So that's like doesn't beat inflation. The organic revenue, the lifeblood of the company, only grew 0.8. But the net income, that's real operating profit and net income fell 21%. So revenue is slightly up, but the net income's down 22. What does that mean in English? Yeah, margin decline. Gross margins were down 9.17. Net margins were down 22% year over year. So that's starting to make sense why the stock is also falling. Looks like revenue growth is slowing. Margins are falling. So that's what's going to make this company trade at a low multiple. But maybe all the worst is priced in at this point. Here's their stores. They have 796 stores, up from 740. I know there's also a lot of increased competition from like Amazon's private label, like yoga clothes and stuff like that, running stuff. But anyway, they're still a money printer. Like next quarter, they're projected to make 200 mil, then 320 mil the quarter after. So they're still making net income every quarter. It's just a growth story and a margin decline story from tariffs and stuff. So what is this one? What do you think of AMAT forward PE? Forward PE looks better than other similar stocks. Let's check it out. Oh, and then we'll do what's up, Paul. We'll do Arista Networks. And is AMD overvalued if you plan to hold long term? It might be still a little overvalued. But I do own AMD. Yeah, for some stocks like Google, Amazon, it's worth buying right now, even at all-time highs if you're a long-term investor. But some stocks like AMD, I don't know if it is worth buying even at all-time highs for the long term. So anyway, here's Applied Materials. Is there any news? Raises price target on AI-driven semiconductor equipment demand. So semiconductor equipment, kind of AI infrastructure play here. Applied Materials reports Q2 results, raises 2026 semiconductor equipment growth forecast to over 30%. That's cool. Applied Materials formed strategic partnerships with Taiwan Semiconductor to develop next generation AI semiconductor technologies. So I believe this is like an international semi play. Yeah, so check this out. Notice like the United States is only 10% of their revenue. So maybe like the China area. China's 30% of the revenue. Taiwan's another 25%. Korea's 20%. So 70% of the revenue is just those three countries. Then the US at 10%. But yeah, this is a growth company. You really want to value them off next year's net income. And when you value them off next year's net income, they're traded only 29 times next year's net income, which is much more attractive than the 41 times net income they currently trade at. And that assumes they don't beat on net income projections. This 29 forward PE is using these orange numbers, and look at how every quarter they historically beat by a good chunk on net income. Like this quarter, they expected 2.15, they did 2.8. So I can now understand why this stock is at a crazy all-time high. They just beat on earnings like crazy. So this is more of like an international AI play because other countries are building out AI like crazy as well. So yeah, there you go. Record net income, 2.8 billion net income. Has it ever been higher? No, it's never been higher before. So there you go. I can now see why this stock has done so well. Plus the good forecast, the partnerships. I don't know if I'd buy this stock at all-time highs though, but I can totally understand why they're at an all-time high. And again, a 29 forward PE, I wouldn't trim. Like if I was up a bunch, I really wouldn't trim or sell my shares because that forward PE is pretty fair. So Paul said Arista Networks. Yeah, this is another AI communication infrastructure company. And we'll do AMD and AVT. Oh, hey, what's up? So Arista Networks right here. This is some data center communication company. Like where these data centers, they have these antennas that communicate with each other. So product revenue grew 36%, service grew 27. So let's see the revenue year over year. So the revenue was 2.7 billion, up 35%. Check that out. This is why I love this stock. Literally, it's like every quarter the revenue hits a new record, and it hit a record this quarter. So they did 2.7 bill of revenue, and not just record revenue, but record net income. They did an after-tax net income over 1 billion this quarter. So hats off to Arista Networks. They're super profitable. 1 billion net income. What's that net margin then? A 30 to 40% net margin every quarter. So they're basically collecting royalties, really good balance sheet. How about the FCF, which stands for free cash flow? Look at that. Record free cash flow this quarter, record net income this quarter, record revenue this quarter. So I can now understand why this one's expensive. So the tough part is they're still a little too expensive to buy now or buy anything meaningfully. But yeah, 40 forward PE isn't too shabby, 40 forward PE for the growth that they have, but it is too expensive to buy now. Actually, Morningstar says they're undervalued. Soaring demand for AI infrastructure and a steady market share gain in high speed data center switching will drive long term value growth. Well, there you go. Okay, next up I saw will you be available for Nvidia earnings? I don't know if I'll be live streaming it, but I'll definitely be watching it. Maybe I will live stream it. What is the app that you're using for trading? Oh, hey, yeah, Abdul, what's up? It's actually a brokerage I'm on. It's where you buy and analyze stocks. It's actually linked in my bio. It's called Mumu. Yeah, if you want to use my affiliate link, I have it linked in my bio there. So anyway, here's Navitas Semiconductor. I would be super careful with this one. I actually would not own this stock right here. They're basically just being propped up on an Nvidia investment. So Nvidia, I think, bought a little of their shares, but here's the bad part. The revenue growth is gone. Look at this. The revenue fell 39% to 8 million. Last quarter fell 59 and 53, 30, 40. So the revenue growth is super negative. And the forecast, well, I guess revenue is supposed to go to 11 million in 2 quarters. But I mean, like, that's still down bad, like, from what it used to be. So what I don't understand is why the stock has had so much, like, I think it's had unjustified momentum. Maybe there's something I don't know, but like they're still going to lose 100 mil a year of net income. The revenue's only hit 11 million. And dang, they're worth $5 billion. This is not a $5 billion company, in my opinion. So, yeah, actually, I would not buy Navitas Semiconductor. I wish I could give you more thoughts on that one, but yeah, sorry. Oh, yeah, AMD. So I actually do own AMD stock. They're actually my largest holding in my Webull portfolio. So AMD, though, it's too expensive to buy. That's the tough thing. It's like your CPU shortage company. AMD Intel CPU inventory tightens as AI drives demand. So yeah, there's like a CPU shortage. So AMD server CPU market share rises to 27. It gains ground from Intel. So actually AMD took some market share over Intel, it looks like. AMD processors capture 46% revenue share in data center market. Well, anyway, yeah, they have this huge data center business that's growing like crazy, but here's the tough part, it's the valuation. They currently traded 140 times net income, but again, it's a growth company, so you value them off next year's net income. Look at how it gets literally cut in half. It falls to a 65 forward PE for next year, so they're only trading at 65 times next year's net income, which is still a little too expensive to pay. So I would want to see it go a little cheaper, but they are experiencing like this year's 100% EPS growth, which is why the stock did so well on earnings. So yeah, here's the data center revenue. That grew highest growth rate on the whole screen. I mean, 57% year over year. Also, here's the projections. Analysts expected 9.9. They did 10.2. And the net income was expected to be 1.24. They did 1.38. And look at the projection. Yeah, it's supposed to go to 2.12. So the net income is going to hit 2.12 billion in 2 quarters. It's never even been close to 2.2 billion before. So that's why this stock, you really value them off next year's net income as a multiple because, yeah, they're going to have pretty much 100% EPS growth. And they have a fortress balance sheet, no net debt. So really good balance sheet, print in free cash flow down here as well, print in net income, taking market share away. Oh, yeah, here's their market share. Didn't I used to show this is their GPU market share. We also just saw their CPU market share is a 27.4. Their GPU market share is a 15. So anyway, kind of like the picks and shovels play. Morningstar says it's a 450 fair value. So, skyrocketing demand for server CPUs driven by agentic AI and strategic expansion in data center GPUs will drive long term value growth. Well, there you go. It's like an NVIDIA alternative. Hey, Lucky, man, what's up, dude? Thanks for those gifts there. If you got a stock you may look at, let me know because I got to go in a minute. But yeah, if you have a last minute stock any of you guys want me to look at, let me know. So, what's up, Chief? He says, can you look at AEP? I'm wondering if its growth is good enough to justify holding or buy something else. So let's check this out. American Electric Power. I think this is a regulated utility, if I remember correctly. Yeah, regulated electric utility. These historically just give you like 7% of your money back a year. They're pretty good, especially with data centers, That should bring a new growth story, be a nice tailwind for these as well. So an 18 forward PE, only trading at 18 times next year's net income, which is fair. So vertically integrated utilities, transmission and distribution, marketing, power transmission. Anyway, if we go to their net income right here, they make good money, 900 million to $1 billion. And the cool thing about the regulated utilities is if they don't get a positive return, the government guarantees them the return. But also at the same time, since they're a regulated utility, they're not allowed to raise prices on consumers without the government's permission. And right now, there's a lot of talk around we don't want retail consumers having to pay more in electricity prices because of data centers. So they might not be able to raise prices as fast as people think, but AP completes 2.6 common stock forward sale offering. Okay, that's no big deal. Anyway, yeah, 18 PE. This chart almost looks identical to Southern Company. So AP, I'd recommend them. They're one of the best utilities, and you get a good yield. The utility that I own, another regulated utility, is ticker symbol SO Southern Company. Similar one, 20 forward PE, 3.3% dividend yield, and a similar looking chart. So, yeah. Or you could just buy the whole industry. I actually love the VPU ETF. So if you don't know which one to buy, I think AEP is like the 5th largest market cap. Southern Company is the 3rd. Constellation Energy is like the 2nd. Or anyway, you could just buy the VPU ETF. It owns all the regulated utilities. Here was the COVID crash. Every year, just like excluding that one COVID dip, this always gives you like 8% of your money back a year. And it's mostly 2.7% in dividends as well. So you get a high yield and good stock price appreciation still. So yeah, this ETF owns NextEra Energy, then Southern Company, Duke, Constellation, then AEP. Yeah, American Electric. So that's 4.55% of the ETF. So yeah, I own Constellation Energy, the one above it, and Southern Company. So yeah, those are my utility plays. All right. Next up, Lucky says, check Salesforce. It's up. Let's check it out. Yeah, CRM, Salesforce. I know, well, they've been beaten down because of Anthropic code and stuff. They're saying Anthropic and OpenAI will hurt all these software companies. But what is this? Salesforce announces $300 million Anthropic AI spend. Wait, like investment in the company? Announced plans to spend $300 million on Anthropic's AI, particularly for coding applications. Huh. So this gives their customers access to Claude Code. So there we go. Benioff praised. What happened to their Agentforce stuff? Their Agentforce stuff has not been going too well. Citigroup cuts price target. Okay. Oh well. Anyway, yeah, this is like super cheap now. If we go to Salesforce's net income multiple, they only trade at 18 times, or basically 19 times next year's net income, which is pretty fair. I mean, or that means all the AI fear is pretty much priced in at this point. I mean, it's not anything investors don't know at this point. Like that's the reason why Salesforce has been hurt so bad, because Claude Code has made like a replicable Salesforce for small businesses. But yeah, I like how diversified that they are. They own Slack, which is one of the best customer relation apps. Almost every S&P 500 company uses Slack, like Amazon uses it. And that Slack business segment, that grew 38% year over year after it grew 12%. So that's like their best product in my opinion. And here's their net income. They're making close to $2 billion of net income a quarter. It's a record, It's up 13% after it grew 18% year over year. They're doing a lot of investments too. Yeah, look, this quarter they spent $9 billion acquiring INFA. They're delisted now, but yeah, they can easily afford this. They spent $8 billion buying this company. That's like 2 quarters of free cash flow. Literally just in free cash flow this quarter, they made $5.3 billion of free cash flow and $2 billion. Q1's their best quarter. They made $6 billion. That's when they always have their best quarter. But anyway, yeah, Salesforce, pretty cool. Be careful with this one because software is so exposed right now and so volatile from this AI stuff. I'd keep the allocation to that one minimal. I wouldn't go crazy buying Salesforce yet, but it is interesting. What do you think about the SpaceX IPO? Yeah, I heard it's going to IPO under SP's or I forget the ticker symbol. Oh well, I forget what it is, but yeah, SpaceX is going to IPO later this year. It's one of the private equity companies. A cool way, or this is a cool, I guess, like ETF already. Here's DXYZ. It's a stock that owns already some SpaceX and also Google. If you guys didn't know, Google owns a bunch of SpaceX. But check out this ETF right here. If you buy this stock or basically ETF, 18% of its holdings are in Anthropic, 15% SpaceX, 6% OpenAI, Databricks, Mr. Beast Industries, which is like the Mr. Beast YouTube channel. Kind of funny here. But annual management fee, I can't believe this. Like, I literally can't believe this. You're paying 2.5% of your whole entire position in fees every year. So that makes this stock unbuyable, in my opinion. So yeah, isn't that crazy? Like if you put $100 into it, you pay $2.50 every year in fees, or just whatever the value is. If your thing declines as well, well, anyway, I'd be careful with that one. Oh, okay. The artist says it's SPSX. That's cool. SPSX. I don't think we can like find it, but yeah. Anyway, SpaceX is supposed to IPO. There's a lot of momentum. Like if we go to the NASA ETF, or it basically just owns a bunch of space stocks, the whole space industry sector has been rallying because of the SpaceX IPO and the Artemis launch. So yeah, like Rocket Lab, ASTS Space Mobile, Planet Lab. Actually, Planet Lab's a really cool one because they give Google Maps the satellite imagery data, like where you can really zoom in and stuff. So yeah, this stock's at an all-time high. Google loves them so much that Google decided to buy the stock. Checked it out. Alphabet, which is Google, owns 10% of this entire company. And yeah, here, I'll go to their website right here, planet.com. They own these Pelican satellites that really give high quality imagery of the Earth that Google Maps uses. It's like 10 years ago, Google Maps, when you zoomed in on stuff, it used to not look that quality, but now it's like really quality. Well, my Wi-Fi isn't, so it's not going to load their website. Oh, bro. Oh, TikTok said I'm AFK. Okay. All right, sorry. TikTok said it was AFK there. Sorry if the stream went out. Well, anyway, I tried to look at Planet Lab, but anyway, Alphabet. I saw the one earlier. Alphabet is just another great stock that is just like a buy and never sell type company. And then I have to go in 5 minutes. So we'll analyze Google or maybe one other stock, and then I gotta go. But I'll do a portfolio update after this. But anyway, here's Google right here. Alphabet. If you didn't know, they own 7.5% of SpaceX. It's one of their best investments. And that's why they're actually in talk with SpaceX for a rocket launch deal to support orbital data center project, which is, I don't think, real. But anyway, Google unveils Google AI powered premium laptop. Oh, that's cool. Google integrate Gemini AI. Google market cap reaches 4.8 trillion, narrows gap between NVIDIA. Yeah, dude. YouTube introduces AI tools and custom ad inventory. Well, anyway, Waymo recalls 3,900 robotaxis over flooded roadway software detection. Cool. So anyway, yeah, it's like a mini Uber. It's like an ETF in one. It's a huge cloud play, advertising play with YouTube. They're in quantum chips, TPUs. Google's selling their own TPUs like crazy, like billions of them to Meta and Anthropic over NVIDIA chips. Google Cloud revenue grew 63%. Oh yeah, they have a backlog, a $600 billion backlog of orders. Did you guys know that? Technically, $200 billion of that backlog is Anthropic, but yeah, check out the Google Cloud revenue. It grew 63% year over year, the highest growth rate on the whole screen. So hats off to Google. Google Cloud grew 63%. Google Services grew 16% year over year. And if we go to their, well, here's speaking of adjustments earlier, look at this. It says they made $62 billion of net income this quarter. That's the after-tax net income. That was an adjustment from a realized gain. The real number was $39 billion, which was still a record profitability quarter. I'm so impressed with Google's numbers. And check out the analyst forecast. They're supposed to make $35 billion in net income next quarter and $37 billion in net income the quarter after. So Gemini AI is huge. It's like taking over ChatGPT. I prefer Gemini over ChatGPT. I love YouTube. I spend way too much time on YouTube. So hey, if you're on YouTube a bunch, why not own some of YouTube stock? And I think, and I'll show you my position after this, they are a little pricey at a 31 forward PE, but I feel like that's not even like max valuation. Google can still like go to like a 35 forward PE before it maxes out for the growth that they have. So yeah, Google's actually my largest holding here in my portfolio, my Robinhood account. This is called, if you look in the top left, this is called my dividend only portfolio, where every stock in here pays a dividend. And Google is obviously not like a pure dividend company. It's like a dividend growth stock. But yeah, we're up 141% on them. We're down 2% all time on McDonald's. We're down on Carlisle. We're up 54% on United Rentals. That's a cool construction AI company. And then Constellation Energy, this is that utility company that owns 33% of all the US's nuclear reactors, which is cool. So yeah, that's here's us the past year. We're only up 13% the past year, and we're negative year to date. So we've definitely underperformed the market. Don't listen to me. I'm not an expert. None of this is financial advice. The S&P 500 is up 25% the past year, and it's up 7% year to date. So we've definitely underperformed the market in this portfolio. We also have a Roth IRA, which we started a year ago, pretty much. And these are all the stocks that we own in here. I try to keep it simple. Like I got 5 holdings in here. What is it, like 6 holdings in here? And then another 6 holdings in here. Oh yeah, here's my Moomoo portfolio. So yeah, that other account we saw underperform the market. Here's the real winner. This is what I'm proud of. Look at this year to date in this account. We are up a whopping 71% return money weighted since January 1st, or $21,000. If we go to from exactly 1 year ago, here's what's crazy. From exactly 1 year ago, we are up 162%. And that's mainly just from our top 2 holdings. You know, our largest holding is up 440% in the past year. Powell Industries is up like 500% the past year. So that's what's led to most. That's how we're up so much year to date. Like this stock right here is just like hits a new record every day. I can't believe it. Same with Powell Industries. You know, don't just buy Nvidia. You know, don't just buy the company selling the chips. Buy the whole ecosystem. You know, buy the companies doing the HVAC work, like Comfort Systems. They do the heating, ventilation, air conditioning. Buy the companies doing the complex MEP work, which is mechanical, electrical, and plumbing work, like Powell Industries doing the electrical work for data centers. By the companies, you know, powering data centers with the nuclear reactors. So I got the Constellation Energy there. And I got AMD. I got Amphenol as well. This is one of the first stocks I went over. It's one of my favorite stocks to actually buy now. One of my genuinely favorite stocks to buy, and I did just buy another share of them, is Amphenol. This is the company that sells copper cables and fiber optics to NVIDIA and Google. So NVIDIA and Google are both customers of Amphenol. And they're cheap. They're only trading at a 23 forward PE. So yeah, that was our most recent purchase. Another one of our most recent purchases has actually been on Coca-Cola Consolidated. We just bought a share of them yesterday at 163. We rose our cost basis. I didn't mind, you know, we bought most of our shares way down here at like 114, but I didn't mind raising my cost basis because they're still cheap. Even on this dip, they're cheap. They're only trading at a 23 PE. So they're trading at 23 times, you know, net income. And, you know, I just love the whole value. I just love this company. It's a staple. It's the Coca-Cola bottler. Actually, I'll show you all their brands. So if you don't like Coca-Cola itself, you'll probably like a lot of the other stuff that they bottle for. So yeah, you know, they bottle for Dr. Pepper, they bottle for Monster, Gold Peak, Vitamin Water, Body Armor, Minute Maid, Smart Water, Sprite, Topo Chico, Powerade, Fanta, Monster. I love Topo Chico, Bang Energy. So yeah, all these great brands. Anyway, yeah, that's the Coca-Cola Consolidated bottler. So yeah. Oh yeah, back to our Robinhood. So yeah, that's our buy and never sell portfolio. This is our Robinhood portfolio. Someone said McDonald's. Yeah. I forgot to cover my other account. What's up, Magic Dude? And he said McDonald's and Microsoft. Yeah, Microsoft is one of my most recent purchases here in my Webull portfolio. So yeah, if you look in the top left, open profit and loss, last portfolio, I promise. We're only up 20% all time in here. So we've definitely underperformed. But yeah, we're up 20% all time in here. And here are all my most recent purchases in their exact order. So the most recent stock I bought was Ouster, which was literally like weeks ago. Like, I can't believe it. There's the buy order right there. And in just like 3 weeks, we're already up 100%. I couldn't believe it. It's like the fastest I've ever doubled on a stock. So I might actually sell out of that one. I don't know. Not one I trust with a lot of money. But yeah, then we bought Uber and Microsoft and Apple in the same day as well. So which wasn't even that long ago either. Like 16% return. You'd think I've been owning Microsoft for like 2 years or something. That's like 2 years of S&P 500 type returns. But I can't believe it. We literally just bought Microsoft for the first time. Here, let me pull that up. Oh, my phone just disconnected from my screen. So hopefully okay, there we go. Cool. Yeah, there's my buy order on Microsoft. Yeah, I bought it at 364 just literally weeks ago. So yeah, Microsoft's another one that you can't go wrong. They're still cheap. Even though they've rallied a little bit, they're still only at a 24 forward PE, or they're only trading at 24 times next year's net income, which is super cheap for the Mag 7 behemoth. Hey, no way, dude. Shout out the member, Marks, dude. Hope you're having a phenomenal Sunday, man. I was actually about to end the stream. You like Topo Chico? Yeah, I love Topo Chico. He says BMNR. Yeah, let's check it out. I think this is like an Ethereum proxy. Actually, let me verify that. Let me pull up the price um of Ethereum over this stock right here. So ETH. Will that work? Will it, or do I need an okay, yeah, it will. Cool. Okay, Ethereum. So yeah, so here's the thing. BMNR is a Ethereum holder. So what this company does is they just own a bunch of Ethereum and they stake it. Uh did we get that by like did they ever like break it down or I don't know. Anyway, yeah. Here's their balance sheet. You really value them. The way you value this company is off the NAV, the net asset value of their Ethereum holdings. So yeah, the best part is they have no debt, literally no liabilities and a ton of assets. And what are these assets? It's Ethereum. So they own a bunch of Ethereum, they stake the Ethereum, and usually the stock just moves with Ethereum. Yeah, it's not exactly perfect, but as you can see, it really rhymes together. You know what I mean? Like it really does like almost move identical. Is there any specific news? Bitmine reduces weekly Ethereum purchases by 74%. How much total Ethereum do they own? So, okay, the company holds 5.2 million Ethereum, worth approximately 12.1 billion, which is 4.3% of all the Ethereum. Wow. So they own 12 billion worth of Ethereum, and the whole market cap is 10 billion. So yeah, anyway, hopefully that was kind of helpful there. You kind of value them off the NAV. And as we can see, the market cap is under the NAV, which is great news. So you recommend Microsoft? Yeah, I do. I not as much as I did 2 weeks ago. Like the time to load the boat on Microsoft was like 2 weeks ago, or down here at like under 400. But under $400, actually, even if your long-term mindset, it's actually worth buying even now. Microsoft, the behemoth, they're at a 22 forward PE. Actually, that's so cheap. You know, they're being hurt because they're a software company. This is the world's number one software company. And if you look at any software stock like a Salesforce, a ServiceNow, whatever, they're all on like this similar downtrend where the stock went from hit an all-time high a year ago and now it's like down bad. But here's why Microsoft is the most hedged, because they literally own 28% of OpenAI. So they're saying AI is going to hurt software. Well, Microsoft, as an OpenAI owner, is hedged. Yeah, look at that. Microsoft generates 30 billion of revenue from OpenAI partnership, exceeding the 13 billion investment. So they invested a long time ago 13 billion into OpenAI. Now they receive like 30 billion like a year from their revenue share agreement. So if you didn't know, they own 28% of OpenAI. And then toward the bottom here, Microsoft is entitled to 20% of all of OpenAI's revenue for 2030. So they just get literally 20% of whatever revenue they make. They just get it through 2030. So anyway, here's their software business. You know, think Excel, Word, PowerPoint, all that spreadsheet. That does 120 billion of annual revenue for Microsoft. So that's why they're hurt. That's why they're being hurt right now as the main software company. But they're also hedged as the cloud play. If AI gets as big as they say, they're going to need a lot more cloud. And Azure Cloud, they are the second largest market share behind AWS. And cloud is booming right now. This cloud business does over 100 billion of annual revenue for Microsoft. It's insane. I love that business as well. I love this. So they're the best software company, number two cloud company, and one of the best AI companies as a huge owner of OpenAI and with that revenue share agreement. So pretty cool. And yeah, here's their net income. They're making basically 30 billion in net income a quarter. And that's what analysts project. It's supposed to be 31 billion next quarter, 34 billion the quarter after. And hey, MC and Lucky, man, thanks for those gifts again. So yeah. Hey, what's up, Narc? Good to see you, man. I mean, I have to go in literally 3 minutes. I have to be somewhere at 2 o'clock. But can you do UiPath? I guess since we have 2 minutes, I can do it really quickly. When I saw Unity, we did Unity earlier. I'm actually not a fan of Unity simply because they lose too much money. But it is a really cool software. It's one of the software companies also hurt by AI. So here's UiPath right here. I am down bad on this company, and I've been diamond handing this stock, and they're just too cheap to sell. If you look at the very bottom right, I've been buying UiPath since 2021, and that's when the stock was, $40, $50 a share. What's the share price today? UiPath is $10 a share today, so I'm down bad on my investment. I can list every mistake they've ever made, from fraud to the CEO leaving out of nowhere. Basically, it was a money grab is what it looked like. So the stock fell on that day. Like there wasn't earnings. They fell because the CEO had this money grab scheme and it sent the stock down. And it's just basically never recovered since. So I really don't love this one. just because I'm like hurt so much by it. But so I'm biased, but they have a net cash position. They're too cheap to sell. Like some companies it's worth to fully sell out of. It's not worth selling out of UiPath. I'm still holding on to my shares. But yeah, they have 1.5 billion of cash and only like 300 million of debt. So they have like over 1 billion in net cash on hand. And they're just now getting net income positive as well. If we zoom out, the net income was always choppy. They'd make money that one quarter, then they lose money all the other quarters. But now, look at this quarter. They actually made 80 million. That's great, actually. That's great news. We want to see them continue that. They've had some one-time adjustments making their EPS look better than it is. But yeah. So I had bought Unity. I think I should sell it for a loss. Well, I just want to have Unity as like a too big, meaningful size position. I just want this as like a really tiny position. This is the software that made Rust. I love Unity, but yeah, here's the scary part. Net income, they lost 350 mil, 90 mil, 100 mil, 100 mil, 80 mil, just for all of eternity. If we just zoom out, all Unity has ever done is like lose a couple 100 mil in net income every quarter. And the revenue's kind of recovering. It's not at its all-time high. Like the revenue was higher in 2023, then it tanked after the CEO left and changed the subscription model to like usage, and now they changed it back. So it's just been kind of weird. What does Morningstar say? Morningstar says they're undervalued. It's robust free cash flow, acceptable financial health. Well, I don't know about it's just a gap net income issue. It's the stock-based comp issue. Because they have good free cash flow, like great free cash flow. But again, you don't look at free cash flow because they're paying employees with stock. And that would have to come out of their net income. So that's why the gap net income is negative and the free cash flow is positive, because they're paying employees hundreds of millions of stock when they would have had to pay them cash. So that's the only thing that does scare me a little bit. Hey, you too, Narco. Hope you have a great day. Oh yeah, AppLove and George. Yeah, really quick, last stock here. Oh wait, actually, hold on here. Maybe my Bible group is canceled. I don't think it is, but I'll just double check. No, it's not canceled. Yeah, I actually do have to go. Okay. Anyway, back to AppLovin though. This is one of my favorite software stocks to buy. It has recovered very nicely, but back here, when all the software stocks were tanking, this one went from 740 to 350. This was no exception. This one tanked like crazy. And this is actually the software stock I bought. Out of all the software stocks to buy, this is my favorite one. Here's why. If we go to revenue, this is so impressive. And yeah, hey, Anya, if you like software like Unity, I think you'll love AppLovin. Check out the revenue. The revenue was 1.84 billion, up 58% year over year. But on this 1.84 billion revenue, they kept after tax 1.21 billion. That, if we zoom out, that is a record, and that is real as well. Someone's like, is that a one-time adjustment? Did they really make 1.2 billion? They really did, because before tax, it was 1.44. After tax was 1.21, which really means their net margin is a 65%. So you go spend $100 on their software and their ads, they keep $65.44 after paying taxes. And the free cash flow is even better. They keep more free cash flow than net income. So they have a 65% net margin and like a 70% free cash flow to sales margin. I just can't believe how the margins here are. So anytime the revenue grows, the profits will follow. Yeah, so revenue's up 58, net income's up 109. That means margin expansion. The net margin grew 31%. Anyway, I think you can understand what I'm trying to say here is, yeah, look, next quarter they're supposed to make 1.26 billion net income, 1.4 billion net income the quarter after. So when we value them off that, it starts to make them look pretty inexpensive. AppLovin only trades at 28 times forward PE, or 28 times next year's net income. I think that's pretty fair. And someone says SAP. I can't do too much in-depth analysis, but let's see what the earnings recap is on SAP. It's a European company. So cloud revenue increased 19%, with cloud ERP suite growing 30%. Operating profit and EPS exceeded analyst expectations. Cool. Free cash flow declined 9% due to a one-time litigation settlement, though the company maintained its full-year free cash flow target and continued share repurchases. Okay, so that's good to know. They had some little one-time litigation adjustment. Is there any other weekly news? SAP unveils autonomous enterprise, launches over 50 assistants and $100 million partnership. Or I say this is European. Invest in AI orchestration platform N8N at 5.2 billion valuation. So they're buying a stake into this company called N8N. Anyway, and yes, SAP's only at a 24 PE. This company only trades at 20 times next year's net income. They have a 1.6% dividend yield. Morningstar says they're undervalued, highly sticky customer switching costs, and its mission critical enterprise resource planning, strong momentum, and its cloud transition will drive long-term value growth. 20 forward PE does seem really cheap. And yeah, that's after we converted the currency from euros. Anyway, I hope you guys have a phenomenal rest of your Sunday. Make sure to hit the like button if you haven't already and hit the follow button if you'd like. I do stream every single Sunday this exact same time. Thank you to all the members like Markers. I have a private Discord if you want to join it. It's in the description. It costs literally $1 to join, $1 one-time fee, or if you become a YouTube member, you also get permanent access to the Discord. Even if you cancel the YouTube membership, you still stay in the Discord forever. So anyway, I just made it the cheap amount of money as possible. Just anyway, see you soon. Thanks again to everyone on the YouTube and TikTok stream. TikTok cooked me because we got taken off the For You page, but oh well. Thanks again.